Good morning, everyone. I'm Brad Smith alongside Julie Hyman. This is Yahoo Finance Live. Let's get right to the three things that you need to know to start off your morning. First thing you need to know, predictions already rolling in for the FOMC May meeting. And the outlook, it's split. Swaps traders are pricing in a 50% probability that the Fed will lift rates by a quarter point. The target rate probability is also sitting around the 50-50 mark. BlackRock, they're taking a firm stance, arguing the banking sector woes won't stop the Fed from continuing rate hikes. This is the Senate banking turmoil is heading and hearing that is set to start. Plus, economic data out this morning provides visibility into consumer confidence. Second thing you need to know, Alibaba is breaking up. The e-commerce giant announcing its $220 billion empire. It's going to be divided into 6 main units. Now, the news comes after last year's crackdowns by Chinese regulators weighed down Chinese tech stocks in 2022. Beijing has since signaled its renewed support of private sector growth. All of this, says Alibaba's billionaire co-founder Jack Ma, who left China and all but disappeared after publicly criticizing Beijing regulators, has returned after more than a year abroad. And third thing you need to know, Walgreens' quarterly earnings results were released this morning. The drugstore chain saw profit during the period sink by more than 20%. That's thanks to a sharp decline in COVID-19 vaccinations and over-the-counter test sales. Still, the drugstore chain topped Wall Street expectations, beat revenue estimates by more than $1 billion, and Walgreens remains optimistic on its outlook ahead, projecting positive core business growth in the year to come. Well, for more on how the banking crisis is allowing the tech sector to open up and provide a haven for investors, we welcome in Chris Versace, who is Thematica Research Chief Investment Officer. Chris, great to see you.
Great to see you, Brad. Great to see you, Julie.
Absolutely. So let's dive into this a little bit more, because it seems like, once again, tech is a reprieve for those who have been exiting some of the banking positions.
I think that's right. I mean, typically when we look for a market to recover, tech is early, right? It's one of the leading sectors. But you have to remember, too, that folks are trying to understand that the second half rebound that's been expected, is it tracking? And I think we'll learn a lot tonight after Micron reports. Remember, back in December, they were the ones who kind of gave the warning shot, if you will, or a renewed warning shot about the PC market, about the smartphone market, talking about data center demand, inventories. So I think folks are going to be really leaning into what they have to say after the close.
To take a step back for a minute and look at how everyone's been sort of positioning this year, trying to game out the Fed. We were just talking about how much argument there is right now about what the Fed's going to be doing next, right? How are you thinking about that? How are you framing that? Or are you sort of going bottoms up and just focusing on individual companies and trying as much as you can to avoid the Fed debate?
Well, you can't avoid the Fed debate because first off, you can't fight the Fed. We all know that, right? So the question to me is, just to set it up, 5.1%, year-end Fed funds rate. Powell said that last week. He said there are no rate cuts, in the Fed's base case, but the market's pricing in multiple rate cuts. So there's clearly an issue that has to be decided here. I think what makes it very hard is folks are trying to figure out this, expected credit tightening, 25 basis points, 50 basis points. And I don't think we're going to know until banks start reporting in a couple weeks. And even then, we may not get the full picture. So I think we're going to be very choppy for the next couple of weeks, to be very frank with you. But based on the data that I've seen, right, and data I'm sure you guys have seen too, right, you look inside the core CPI report for February, right, month over month, 3 months in a row of moving higher. That's not what the Fed wants to see. And then at the same time, the February PPI report, services still up at 6% year over year. That's a big number. So what I suspect will happen is that we're going to go through this, cycle with banks, and I hopefully today we'll get a little more clarity on that. We'll get a sense as to what the credit tightening looks like. But before too long, it's going to be back to the inflation data.
So there's, in one camp, steady on the pathway ahead for the Fed. But then there's also what Double Line Capital's Jeffrey Gundlach told CNBC, saying that they need to respond very dramatically. How different is a dramatic response versus just steady as we go right now?
I don't think that the Fed's role, remember, is always like a cheerleader to the economy, right? So I don't think that they're going to do anything overly dramatic. Think of what they've done over the last, couple of weekends, right, to shore up the banking system, to make folks comfortable, right? And again, we'll hear more testimony from Barr today to that effect. So I don't think that's going to happen. To me, the bigger move is, how many rate cuts does the market have to dial back that it's expecting, not the Fed doing something dramatic?
Right, and that's sort of in line with what BlackRock has been saying,
Yes.
right? That the market is getting a little ahead of itself. So let's circle back to what we talked about at the beginning, which is positioning right now. Because as I wrote about in today's morning brief, people have been piling into tech stocks as sort of an area of safety, which is a little bit counterintuitive maybe, or just an area of that they want to get away from the banks. Is that a sort of delicate position for the market to be in?
The market's always forward-looking, right? And there's some debate, is it 3 months, 6 months, 9 months? So, as I was saying before, there is this expected recovery in technology as, demand picks up, as inventories in the channel kind of get worked down. And remember, the second half of the year tends to be seasonally stronger for tech anyway. But, I think we're all looking for those data points that say, oh, yes, it is firming, it is on track. At the same time, there is the potential that we get some news that says, oh, things have worked down faster than we expected. You can almost make it a little analogous to the retailers where, at the end of last year, bloated inventories, and a number of them took it really on the chin, look at their margins, but they really, really worked their inventories down. So if we start to hear that, and the channel is clear, you might see people get even more excited about some tech companies.
Is that to say that the worst of tech's issues are behind it right now? I mean, we're talking about an advertising market that we were talking about drying up on the digital side that impacts everything from social media companies to the ad duopolies that are out there. And some of them also, in Alphabet's case, they're in the consumer tech landscape that gets hit on the consumer discretionary side as well.
So that's actually a great point because it calls out the fact that tech is this big amorphous thing. And there's really different areas of technology, right? There's everything from software to, as you're talking about, social media, even in the chip space, right? What's the end market? Are you in PCs? Are you in smartphones? Are you in data center, right? Or IoT or some other areas? And I think there are pockets that are doing stronger than others, data center in particular. So you really have to be selective in this environment.
I'm going to ask you, I'm going to call an audible here. Do you own Alibaba?
No.
You don't know, because we're going to talk about Alibaba next. Do you
Let's
want to
do
talk
it.
about Alibaba
Sure.
with us? All right, let's do that. So Chris, you're going to stick around. Let's talk about what's going on with Alibaba, because it's pretty interesting here. The company is announcing it's going to split into 6 separate units in the biggest restructuring of its 24-year history. The groups range from cloud intelligence to e-commerce, and each will be managed by their own CEO and board, and will have separate IPOs potentially eventually. This comes as the current Alibaba CEO, Jack Ma, suddenly resurfaced in China after a year-long absence. Chris, sorry to put you on the spot here, but just to give a little bit of background on this, I mean, this seems to be pretty entirely unexpected, right, that this is happening. And it's a $220 billion company, enormous company here, and analysts seem to be saying it's been trading at depressed valuation, so maybe this would help matters. I mean, is this something you've been watching?
So, we have seen companies do spin-offs before to unlock, value. Kellogg's is going through this right now, itself. And I remember, several other companies have tried it in the last few years. And typically it tends to work because you're able to really isolate the value through like a peer valuation, some of the parts valuation, if you will. And it tends to be very positive. I guess the question I would ask is, why now? Right? That's always what's the catalyst to thinking behind this. But I also find it's a little fascinating because if I remember the news this morning, Google is asking for a lawsuit to be dismissed where they're trying to break its ad tech business up into different pieces. So it's quite interesting to me that a Chinese company is doing this while some of our companies are trying to stay together.
Right. Well, at the same time, it's also, if this does, as it is moving forward, what does this mean for the data? Is one customer, one part of the business's customer, versus now having some ties into all of those businesses? And what are the synergies that they might lose out on as a result of this?
That's a wonderful question for the conference call if there was one, because, I mean, as we know, right, the data is key.
Yeah.
Right? If you control the data, you control the business. So I have no idea, but I think that's a great point, Brad.
Well, then to broaden it out, of course, the other big factor here is China and the Chinese government and its involvement in the company and the speculation that it had something to do with Jack Ma's vacation after he was critical of the company. And so just to broaden it out, I'm curious if you're looking at China stocks at all at an interesting place right now, or if it's just something you want to stay away from because there are uncertainties about the relationship between the U.S. and China, about China regulations still. What's your thinking?
So there's direct and indirect ways to play China, right? So, you could buy Chinese stocks. We've always shied away from that in the Action Alerts Plus portfolio. Rather, the reopening of China, I think, is far more interesting. We do have several positions for that, including, Coty, which is, doing very well as luxury demand rebounds. So that's the way that we would play it. And you have to remember, too, that whenever you deal with international companies, you always have to reconcile the accounting back. So I think it's easier for the average investor, the individual investor, to either do it through, say, ETF vehicles or through ADRs because they file with the SEC.
You don't own Alibaba, but for someone out there who does, and they're reading this news this morning, I mean, what are they to make of this at the end of the day?
I think you need to understand the news structure and exactly what it means, but it's possible opportunity. Like we said before, there are numerous cases in the past when this happens that value gets unlocked. But the question is, as this separation occurs, how many shares are you getting in each business? Is that part of the strategy? And then you have to decide, which of the 6 do you want? Do you want all of them? Do you want some of them? So there's really a lot more questions.
Chris.
Thanks for playing along.
Yeah.
On the fly with that
Happy to do it.
Appreciate it.
So thanks for coming and joining us in studio, live and living color. Chris Versace, Tematica Research Chief Investment Officer. Thanks so much for joining us.
Thank you.
Absolutely. And Walgreens this morning is out with its latest earnings. The drugstore chain beat on the top and bottom lines, but its quarterly profit fell over 20% from last winter, when it had a much stronger COVID vaccine volume and test sales. Now, its revenue, that rose year over year, with its healthcare unit, primary care service, and home care unit all making big gains. We'll get more into Walgreens' earnings and outlook later on in the show. Well, as we have been breaking down, after a brutal 2022, tech stocks, they found themselves in an unusual position this year. The sector, it's now become a safe haven for investors that are looking to avoid risk amid the banking crisis. You can read all about that in today's morning brief that's up on the Yahoo Finance homepage, even as we're taking a look at XLK on the day, up by about 17%. For more, let's toss it on over to the author of this morning's morning brief, Julie Hyman.
Thank you, Brad. Appreciate it. So basically what we've been seeing is that there has been this concentration, if you will, of what's been going on in the S&P 500. So here is the 2022 sector performance for the S&P. It was down 19% in 2022. Energy, the big outperformer last year, 27% up. Communication services and infotech, two of the worst performers last year. And then this year, we've seen a rotation, right, where that has been changing. And communication services and tech have been the two best performers this year for reasons that we have discussed frequently on the show. That people have been going there as a perceived area of safety. They've been migrating away from the likes of the financials. So with the gains that we have seen in those particular groups, there are two stocks in particular that have been benefiting. I'm talking about Apple and Microsoft. The two stocks up in the neighborhood of 15 to 20% for the year to date this year. That means that their combined weighting in the S&P is something like 13%, and their combined weighting in the Nasdaq 100 is closer to 25%. Now, for some investors, that's not an area of concern. They just want to buy these stocks because they like the fundamentals right now. For other investors like Steve Sosnick, who we spoke to yesterday, he said the problem then is that it can, if one of these stocks has an issue, if it loses confidence, if it has a bad earnings report, it can take the whole index or indices, if we're talking about the S&P and the Nasdaq, down with it. So just something to keep an eye on as we talk about what's happening with these tech stocks outperforming this year. So that's something to continue to keep an eye on. In the meantime, the backdrop for that is, of course, interest rates, right? We have seen interest rates come down. That's something that's helped out those tech stocks. And the debate over the Fed's path ahead continues, as we've been discussing this morning. Double Line Capital's Jeffrey Gundlach said in an interview with CNBC that the Fed will cut interest rates this year as it responds to what he says is an inevitable recession. At the same time, Wall Street heavyweight BlackRock is saying the Fed's going to keep raising interest rates, despite what markets and investors are betting. We just heard that from Chris Versace as well. Let's find out where Evercore ISI Vice Chair Krishna Guha sits in this debate. Krishna, thank you so much for being with us. Really appreciate it. So we do have this debate, maybe an unusually acute debate right now over what the Fed's going to do next. Where do you stand on whether we are going to get more increases or even see cuts this year? Krishna, I believe we're having trouble hearing you right now, so we're going to try and fix.
Let's try that again. Can you got me now?
Yes, we got you now, Krishna.
I'm so
Thank
sorry.
you. That's all right.
So I think the Fed has made it pretty clear that there is much more uncertainty as to how much further they'll need to hike, given the stress in the banking system and the type of credit squeeze that that's likely to generate. And so they'll be very focused on the upcoming credit data. So everything from the bank senior loan officer survey to the actual money and credit data itself, to surveys like NFIB, which will measure from the borrower perspective how much credit restraint is coming through. Powell, as you'll recall, was sort of guesstimating that maybe we might get a quarter point of hiking worth of tightening out of credit, maybe a bit more. I guess I'd be more in the 50 basis point sort of base case. But the real point is no one really knows, right? So we're going to have to observe the data very carefully over the next several weeks heading up to that Fed May meeting and again, the June meeting beyond that. Feels like the most likely outcome right now is that they will nudge rates up one more quarter point. I'd say the next most likely outcome is probably no more hikes at all, that after the fact they do turn out to be done here. But if the credit squeeze turns out to be not that serious and the macro data comes in hot, we could still get 2 or 3 more hikes from here. When it comes to cuts, well, I think we have to understand it's possible to get a cut, maybe even 2 at the very back end of the year in a good news outcome where disinflation is coming through rapidly. But the type of cuts the market has been pricing in earlier, more aggressive cuts, you only get that if the economy is going to a very bad place because of the banking stress.
Is that banking stress signaling the precursory effects of, or the precursory events of a recession, in your opinion?
So it was always the case that it was going to be challenging for the Fed to achieve this fabled soft or soft-ish landing. And that just gets harder with the bank stress because you're clearly getting some extra restraint here, but nailing down how much is really hard, right? And so the Fed can screw this up either way, either by judging that the bank stress and the credit shock is going to be a big deal and it turns out it's not, or that it's not such of a big deal and it turns out that it is. So it certainly feels to me like, recession probability, which I always thought even earlier this year when there was a lot of enthusiasm around, was probably still a little higher than 50-50, that recession probability has got to have gone up. It doesn't mean it's a slam dunk. The labor market in particular has got a lot of momentum here, so it won't be easy to tip it over. But certainly, it's no surprise that investors are positioning for an outlook where there's greater likelihood of a recession.
Krishna, I really liked a point that you made in a recent note where you said, because inflation is elevated, the bar for cutting is high, cutting rates that is high, and much higher than the bar for pausing or stopping hikes. And inflation has remained stubbornly elevated. Do you think that continues and therefore, the Fed has prioritized the inflation fighting? I assume you think that's going to continue to be the case.
So first up, I think the underlying focus of the Fed very much remains on inflation. It's true of most of the central banks. It remains, of course, though, also true that in the very near term, if the financial stability issues looked like they were getting out of hand, as opposed to maybe coming back under some degree of control, that can trump the inflation objective in the very near term. The Fed is trying to walk and chew gum at the same time. That's conditional on the financial stability interventions succeeding in at least tamping down the aggregate system level stability, if not necessarily restoring the viability of all the troubled banks. But as I mentioned in that note, you were kind enough to flag up, I think it's really important for folks to recognize that the bar for pausing versus the bar for cutting are very, very different. I've actually felt for a while, even before the bank stress, that the bar for pausing, once you're up in the sort of high 4s or in the zip code of 5% on Fed funds, and everyone agrees you're kind of restricted, bar for pausing is not that high. But the bar for cutting is much higher. And it's not just higher in a quantitative sense. it's higher in a qualitative sense as well, meaning that you can pause on a sort of expectation that things are going to move in a more disinflationary direction. But in principle, at least, you're only cutting upon substantial further realized progress in moving towards inflation heading back towards target. Now, of course, in a severe enough episode, a really sharp downturn of the real economies of, large negative payroll prints, or a full-blown sudden stop to credit, severe tightening of financial conditions, I'm pretty sure that could stop out the Fed's focus on realized inflation progress. But again, not the possibility of such things happening, only the actual realization of it. So the punchline is, we've lived in a world for decades where the Fed could cut rates preemptively when downside risks emerge. They can still cut, but they can only cut now reactively. And that's very different for risk.
That is a really interesting point and good perspective. So I'm curious then what you make of the likes of Jeff Gundlach or, say, Cathie Wood waving their arms and talking about a recession, some of them even talking about deflation in this environment. Are they just off base? Are they early? What do you think?
So again, first of all, I think if it were the case that the banking stress spread, became more severe, generated a very large disinflationary shock through the credit channel, the economy started to turn down in a serious way, and then we would get rate cuts. But again, not preemptively, upon the realization of those adverse scenarios. When you look further out to the end of this year, early part of next year, there's then a slightly different debate. And that has more to do with how you think about the underlying inflation and disinflation dynamic in the first place. And there are a number of people in the market, and I associate myself with a moderate version of this view, who feel that the disinflation process, given a bit of time, may move a bit faster than the Fed is anticipating. And so you could eventually get to a situation, if you like, of good news cuts. The good news here being we're not cutting because the economy is contracting severely. We're cutting because the disinflation process is moving faster than we thought. We're now seeing, real, tangible, hard evidence inflation moving back towards target in a timely manner. But that's probably not going to be the case until the very late part of this year at the earliest.
Should CEOs then be confident on their businesses either restabilizing or normalizing, or even seeing the reassumption of growth in the back half of this year then?
I think all businesses are likely to be cautious, and rightly so, in this environment. We've already had a lot of Fed tightening, the lagged effect of which hasn't all arrived. In fact, arguably, one can interpret at least a bit of what's happened here in terms of banking stresses as part of the lagged effect of Fed tightening coming through. Though, of course, they didn't intend to cause stress as opposed to a tightening up of monetary and financial conditions. And now we have the wild card of, who knows how much severity of a credit squeeze coming. So, as I mentioned earlier, I think the probability that we go into some form of a recession later this year, or by the turn of the year, has gone up appreciably. And I think corporates would be wise to, behave accordingly.
Well, we'll see what happens, and we'll check in with you. Krishna Guha, great to get some time with you this morning. Thank you so much. Appreciate it. Evercore ISI Vice Chair Krishna Guha.
Pleasure. Thank you.
Thank you. Coming up, we'll check in on shares of Occidental Petroleum. Guess who's buying again? Well, it's not really a tough guess, but we'll tell you. And we'll have the opening bell next. Still a few minutes left till the opening bell. Let's take a look at some movers that we're watching. Occidental Petroleum up about 2% this morning. Different day, same buyer. We're talking about Warren Buffett's Berkshire Hathaway upping its stake again in the petroleum company to over 23% after buying an additional 3.7 million shares here. That takes its indirect ownership to about 212 million shares. Berkshire owns about 24% or so of Occidental, and it's just been this steady drip that it has been buying of those shares. Separately, it got an upgrade to outperform from market perform over at Cowen, with the analysts there saying it's got superior exposure to oil pricing. That's one of the reasons that it likes the stock.
Yeah, saying that they see a superior risk-reward balance there for Occidental Petroleum. So those that abode of confidence and to crude pricing specifically is what they noted here. Crude pricing, capital structure shifts, captive buying support from Berkshire Hathaway, which was aforementioned and we saw come through today. And then also a favorable free cash yield plus a differentiated catalyst-rich profile in a world of relatively homogeneity across E&Ps.
Yeah, I mean, so it's exploration and production, right?
Yeah.
It does that in the oil space, but it also apparently has a low carbon ventures business that the analyst is highlighting here, and that it's that business, which does carbon capture, storage, utilization, has what the analyst says are unique tax efficient benefits. So interesting little piece there in addition to that very big buyer that has been supporting it. I mean, that said, by the way, the stock is down along with many of its peers this year. It's off, I think, by about 5% for the year to date, even if it as it's rising once again this morning.
Yeah, year to date, the entire sector,
Yeah.
XLE, you look at that, that's down by about 5.75%. So kind of mirroring what we've seen within shares of OXY for the start of the year as we're about to round out or at least end out the first quarter of this year. My, how time has flown. But at the end of the day, XLE, of course, the biggest move to the upside that we'd seen in the markets last year. Here, as we've seen, of course, a little bit of a reversal of some of those trends early on in the year, where technology had taken a hit on the chin last year. That now one of the biggest rebound stories that we've seen. Energy on the other side of that trade there.
Yeah, exactly. It's been a little flippy flop that we've seen in these markets here in terms of sector leadership. We're coming up on the opening bell right now in less than 30 seconds. And after gains yesterday for the Dow and the S&P, we are looking at those melt away or at least not be much change today. The Nasdaq did fall yesterday by about 0.5%, and futures there are indicating a future decline, or further declines, I should say. So there we got the opening bell here on this Tuesday morning. And again, looking at those stocks opening up a little bit lower here as we've got the opening bell. It seems as though investors, while they're weighing what the Fed may do next, the next big catalyst on that front is going to be the PCE report on Friday, the Fed's preferred measure of inflation. Our market check here sponsored by Tasty Trade. And as we see the markets go down, it doesn't seem like people are wanting to step in front of that train, so to speak, right? They maybe not wanting to make a lot of bets ahead of the PCE numbers. We're sort of in this earnings lull, if you will, right now. We've got some, but none of them are sort of market dominant. So we're in this in-between period right now where people are waiting for more data, waiting for more direction from the Fed. They're going to be watching that bank hearing today quite closely. But all of that said, not equaling a lot of change in the price action today, Brad.
Not. And as we're taking a look at the major averages out of the open, we've got the Nasdaq Composite at least up here on the screen for you. That is down by about 0.2% out of the gate here. I'm going to try and rejigger just so we get this populated. And even if not, we can take a look at the heat map here and we'll get a look at the Dow components just to see how things are starting off early on in today's session. The Dow Jones Industrial Average, largely most of the components in the red on the day. One significant mover to the downside as of right now, Travelers Companies, that's down 0.7%, biggest laggard in the Dow. However, Walgreens Boots Alliance, which we're going to break down in just a little bit, that is higher by about 2.6%. We'll come back to that, give you some more of the deets on that. You've got also Visa, Nike, two of the outperformers there, but just fractional gains there. And then the NASDAQ, you're seeing that largely, well, it's kind of mixed on the day, actually. About as split as you can get, at least on first eye's glance here. But taking a look at some of the biggest movers here, just to put that back on the mega cap scale here, where that's outsized on the market cap side. You've got Apple, that's down by about 0.25%. Microsoft and Google also in the red. Amazon, you're seeing that flat just barely to the upside. And for the Tesla investors out there, you're seeing some declines out of the gate here on the day. Lastly, we'll check in on the S&P 500, 11 sectors. You're relatively, well, actually, you've only got about 3 gainers right now. Staples seems to be one of those out of the gate this morning. You're seeing that up by about 0.2% on the sector perspective. However, real estate, that is down by about 0.9% right now. And so we'll continue to track this. Overall, the average is lower by about 0.25% right now early in today's trade activity.
Yeah, we've had some rockiness in real estate as of late, so it looks like that's continuing. Let's talk about Walgreens. That company's earnings beat for the second quarter. That's probably helping that Staples group that Brad was just talking about. Revenue rose over 3% year over year. Yahoo Finance's Anjali Kamlani joins us now for more. This is such an interesting story because it's one of these pharmacy companies that's gotten into primary care, and it seems to be working.
It does seem to be working, but also other things are working too. And I found it really interesting just listening to the call, which just ended now, looking at what is contributing to this strong outlook for Walgreens. Of course, they've been impacted like everyone else with the COVID-19 front. Vaccinations down 80% compared to this time last year, and testing down 90% compared to this time last year. But on the flip side, really positive outlook for their prescription filling, for even the front of the store business, which we know we've talked about on the show many times for many pharmacies has been a struggle. They are seeing that increase. And then comes in that the medical care sector with Village MD. They've said that co-branded locations are contributing to at least a 50% opt-in for filling of prescriptions. So they can clearly see that boost and that link there. So all told, really an interesting sort of mixed bag when we talk about, as we have, what pharmacies are doing, and specifically Walgreens seeing that benefit there. They've also seen the growth in prescriptions as well. So they've said that, with reimbursement pressures decreasing from year over year compared to last year, they're seeing that there might not be as much pressure to just do absolute numbers and actually be able to work on reimbursements and filling prescriptions that are focused more on health outcomes. And that comes, of course, from the broader picture that you see in that health insurance and healthcare market right now with everything that's going on at the federal level. So it seems like all things are kind of moving in a decently positive direction for this company.
I mean, one interesting part about this, and largely as we think about the pharmacy side of the business versus the retail side of the business, the retail side saw sales decrease by about 1.8%. Comp sales decreased by about 1% in the quarter compared to growth in the prior years as well. And so does that really kind of just come back to or have this correlation to how many people are coming in for those vaccinations and for those appointments, or even just to buy some of the test kits?
Just people back, in the stores as usual. Absolutely. I also want to point out that, in addition to the in-store part, that the focus on, mail order pharmacy as well, that's something that's really trending in the industry, and that they clearly are benefiting from that as well. There was mention about how, as the pandemic hit, more people found it convenient as well as cost effective to get their prescriptions mail ordered. So it seems like that trend is sticking.
All right, Anjali, stay with us because Oscar Health, that's also in focus this morning on news that the health insurer has named Mark Bertolini as its new CEO. Bertolini, the former CEO of Aetna, will step into his new role at Oscar Health next month in hopes of helping the company become a profitable insurance business here. Shares, investors are liking this. It seems shares are up by about 50% on this news. Bertolini also going to be joining our programming later this morning around 11:30 a.m. Anj, you're all over that. So what are some of the top kind of takeaways from this decision over at Oscar Health?
Well, we definitely need to take note that Mark is, of course, a big name in the insurance industry, long-time veteran, serving as CEO of one of the largest insurers. So that brings possibly some stability to this company, which has, it started off as this key disruptor in the insurance space, really focusing on insurtech as a concept. And while it has struggled in the past few years, to maintain that momentum, it does seem that having Mark at the helm could bring some of that more traditional insurance knowledge, to the company. But they have held their own over time. They've partnered with Cigna, which is also one of Mark's old stomping grounds. So it will be an interesting outlook for the company. He has said that, in a statement today, that he really does still see Oscar as a challenger in the industry. So the fact that this is believing in sort of the core performance of the company should be interesting to see. We are also going to be hearing from both the current CEO, Mario, as well as Mark at around 10 o'clock. So I'll bring you some of that a little bit later.
All right, Yahoo Finance's own Anjali Kamlani. Looking forward to that interview as well. Anjali will be tuning in, as we know our viewers will also. Thanks so much. We're also watching shares of Alibaba after the Chinese e-commerce giant announced it's going to be splitting into 6 divisions. We'll explain how we got here later on in the show. Shares are up by about 9% as of right now for its U.S. traded shares, and we'll continue to track that movement on the day. But coming up after the break, Meta is reportedly dialing back on its bonus payments, according to the Wall Street Journal. Dan Halley, he's got the details next. Meta is cutting back on its decision to make bonus payments. The social media company is reportedly diminishing bonus payments to some employees and ramping up the frequency of its performance reviews, according to the Wall Street Journal. Yahoo Finance's Dan Halley has the latest. Dan, why the reversal here?
Yeah, it's all part of Mark Zuckerberg's year of efficiency push. And so basically what's happening is they're going to do 2 performance reviews each year rather than 1. And those employees that get, and this is according to the Journal, a met most expectations rating will see their bonus multiplier from 85% to 65%. So they'll be taking a hit financially if they get that kind of rating compared to what they would have gotten perhaps in prior years. And this comes after the company had previously decided to give number of more employees lower reviews, basically telling them that they were meeting expectations or more or less kind of riding the line there. That was basically a way to kind of push employees out the door as they were looking to kind of cut back on headcount. Now, remember, this comes after Meta laid off 11,000 workers in November and then 10,000 workers this past month. So 21,000 workers in total. They also decided that they weren't going to hire 5,000 open spots of employees. So they're really cutting back here a great deal. They're trying to get a hold on spending. This is something that they've been doing to please shareholders, obviously, because the company has just been hemorrhaging money through that metaverse initiative. They spent $10 billion in 2021, $13 billion in 2022, and it's expected to increase from there. Though what they said in their last earnings call was that they're cutting back on CapEx compared to what their prior expectations or their prior guidance was for that. So it's all really part of Mark Zuckerberg's plan to try to cut back on spending, eliminating managers. They say flattening the org structure is something that he keeps saying. But, that basically means we're getting rid of jobs.
And speaking about another company that has cut way back and is now trying to figure out what to do to make money, Twitter. It's making headlines. Elon Musk tweeted that only verified accounts will be recommended on the platform's For You feed. That starts on April 15th. In other words, we got a pay-to-play situation.
Yeah, exactly. And that's something that, I think for most users, they're going to just shrug their shoulders and go, okay. I think that's mostly for institutional users, celebrities, perhaps influencers, things along those lines, because those are the people that really want to get their tweets kind of, recognized by the broader public. For me, look, I just want, people who follow me or people who follow them to be able to see what I post, which is normally just dumb stuff, or my articles, which is great stuff. But I think that, this is something that it's another push by Elon Musk and Twitter to just try to get revenue sources outside of the advertising arm. They, are obviously offering Twitter Blue. That's a way for them to, get people to want to sign on, to get the check mark, to get text-based two-factor authentication, to be able to tweet longer tweets and edit for a certain amount of time longer. And so, it's part of the overall effort for him to not have to rely on advertising, which, has taken a hit. Advertisers started to leave the platform when he took over. They're not sure if they want to return. Twitter's been trying to sweeten the pot for them, offering free advertising to a degree, or reduced pricing on advertising. So this is something that, I think we're going to continue to see these kind of different schemes that he might be able to put together to try to bring in more revenue. And don't forget, the value of the company was cut from $44 billion to $20 billion, according to recent reports. So we'll just have to see how this all kind of works its way out. If it works, maybe he'll decide that there are other ways to generate better revenue outside of just needing advertisers.
Right, exactly. Well, $250 billion valuation. Here we come, right, Dan? Thanks so much for breaking all this down for us. Appreciate it. Coming up, Lyft is shifting gears in its leadership structure. We're going to speak to an analyst from RBC about the stock, which is up 6% today. That's next. Lyft announced that its CEO Logan Green and President John Zimmer are going to step aside, making way for incoming CEO David Risher, who's a former retail executive at Amazon. Risher going to take on that CEO role on April 17th. Green and Zimmer will transition to serve solely on the board. Let's bring in RBC Capital Markets Internet analyst Brad Erickson. Brad, it's great to see you. So is this the solution that Lyft needed, right? It's sort of a distant second to Uber at this point in rideshare. Is this new guy going to fix it?
Yeah, I think, when we saw the news last night, we came out with some comments, and I think we kind of framed it as more of like a, hey, why not type situation, right? These guys have really struggled with, various aspects of, we'll call it misexecution and market challenges, competitive challenges. And we think they're operating at a structural disadvantage to Uber, specifically here in the US. And so, yeah, I think, getting a fresh set of eyes on things, the founders, this is obviously a very emotional thing for the founders. I think getting them to step away more in a board capacity, less operationally so. You bring this guy in who is presumably a very good operator, certainly with some long track record of experience at Amazon, and we'll see what he can do. The details on the shareholder letter were scant, I would say at this point, but apparently they're holding an all hands meeting today with the company, and probably likely to see more details emerge here on any new strategic initiatives.
Brad, Julie knows that one of my favorite Harvard Business Review stats to cite is the fact that after 3 years for a company being public, if their co-founders or founders still at the CEO helm, they tend to not see that show up in terms of the stock price reaction and it actually resulting in positive shareholder value. So this, no doubt, perhaps a good move for shareholders, but at the end of the day, shareholders probably still asking, what applicable experience does Risher have that can easily translate over into a ride-hailing business?
Yeah, I mean, I think clearly, when you go back to whether it's the Microsoft portion of his career or certainly the Amazon portion, Lyft is a two-sided marketplace. After all, digital marketplaces often have many of the same characteristics, and certainly he was the 37th employee at Amazon, arguably the biggest two-sided marketplace of all time in the world. And so I think that's kind of the most established statement we can make at this point about what his experience level is. But certainly when it comes to the aspect of, new customer acquisition, running a business that's fairly low margin inherently, but needs to ramp in the eyes of shareholders over time, there's certainly some experience there. We'll see how he does, as I said.
Brad, to be clear, you guys aren't stepping in to buy this thing on this news. And you say in your note, the challenge from here, address the structural disadvantage versus Uber. But how? And that really is the big question, right? I mean, how do they do that?
Yeah, I mean, we don't know. And yes, we are not stepping in even with this headline. Yeah, I mean, I think we also came out with an analysis just last night to kind of further support that view of Uber having a structural advantage. And I'll just give you two examples. We took a look at kind of the 10 largest markets in the US competitively, kind of side-by-side rides. And what we continue to find is Uber is driving declines in their pickup time. So meaning it's a shorter wait to get an Uber than a Lyft, and that's changing in favor of Uber. And so that drives conversion. And then separately, we're continuing to see evidence that Lyft is having to cut price, which we view as a reflection of needing to sort of stave off further market share losses. And so, that's a very, very tough compounding sort of virtuous cycle to stop once you're going down that road. As I said, management team's got its work cut out for them, I would say.
Previously, we've talked about the need for more drivers to come online as well in order to have either prices come down for riders and then even for, as you were mentioning, the wait times to decrease as well. Is that something that we're actively seeing? Are more drivers signing up to get back into the gig economy wherever jurisdictionally possible? And who is winning out the majority of those drivers from your perspective and your analysis?
Yeah, I think as coming out of COVID, and obviously we had a unique situation with federal and state level stimulus that was sort of impeding people re-entering the workforce in many cases where there had been a lot of, say, services, job losses. I think now, in light of inflation and some of the other macro headwinds, you are seeing a bigger tailwind to those drivers coming back. And you've seen that for the last several quarters, and the companies have been vocal in talking about it. I think back to that structural disadvantage piece, though, we do think Uber has been generally winning that battle. And again, part of that relates to they can pay drivers more per hour because, for example, they're pricing higher and they're getting better utilization. And so if you're Lyft, and this is what we called out in our note, the risk here is that you have to sort of double down and dip back into paying more incentives, and that comes straight out of margin. As we've seen, we've had a few quarters of disappointing guidance related to this over the last, I guess, 3 or 4 quarters for Lyft, and we're flagging that as a potential ongoing risk here, again, as a function of that structural disadvantage I keep talking about.
Yep. Poor Lyft, maybe. All right, Brad, thanks so much. Brad Erickson, RBC Capital Markets Internet Analyst.
Optimistic.
All good. It's great to have that perspective. I appreciate it. Well, let's take a look at one trending ticker that we are watching this morning. Paramount's getting a boost after the media company got an upgrade from Bank of America from neutral to buy. The bank raised its price target from $24 to $32, citing Paramount's assets that have, quote, significant buyer interest if they're ever put up for a sale. The value of the portfolio, says B of A, provides a floor in shares over the near term. They're moving up today by some 6%. We'll be right back. We are moments away from the start of the Senate's first hearing on the failures of Silicon Valley Bank and Signature Bank, with lawmakers expected to grill regulators on how they handled the crisis and ensuing bank contagion fears. Rochelle Akufo is going to be monitoring that, of course, and helming the 11 a.m. hour. And so what are we expecting here? We've gotten some of the statements that are out already, and so we know a little bit of the flavor of what some of the responses are going to be.
We do. I mean, and going into this is going to be a bipartisan hearing. We have both Democrats and Republicans that will be focusing on different sorts of areas of blame here. So you have the Democrats who will be looking at the impact of regulatory rollbacks. Republicans, meanwhile, probably focusing on the lack of supervision by the Fed, the Treasury, and the FDIC. We'll be hearing from the chairman of the FDIC, Martin Grunberg, and the Fed Vice Chair for Supervision, that's Michael Barr. They'll be among those testifying. And as we mentioned there, that prepared testimony is out. Now, Grunberg is going to be putting some figures to some of this fallout here. The cost to the Deposit Insurance Fund to cover SVB, looking at $20 billion, $18 billion, and that's covering uninsured depositors. And for Signature Bank, $2.5 billion, $1.6 billion of that going to uninsured depositors. Now, these amounts are still subject to change. They're still going through the numbers at the moment. But we know that Grunberg is also going to hint, or at least tap into some of these regulatory changes that he'd like to see from mid-sized banks. In his prepared remarks, he'll say, quote, the prudential regulation of these institutions merits serious attention, particularly for capital, liquidity, and interest rate risk. This would include the capital treatment associated with unrealized losses in bank securities portfolios. Resolution plan requirements for these institutions also merits review. So really highlighting what he's going to be focused on, those unrealized losses, clearly with a big headline for these banks failing. And then also looking at Barr's prepared remarks, he's going to testify that SVB failed because the bank's management did not effectively manage its interest rate and liquidity risk, something that we've been talking about. But also SVB's failure demands a thorough review of what happened, including the Fed's oversight of the bank. I'm committed to ensuring that the Federal Reserve fully accounts for any supervisory or regulatory failings and that we fully address what went wrong. So still taking some accountability in terms of the engagement between the Fed and these banks. So, I mean, we're really looking for accountability that lawmakers are going to be pressing on, but also reassuring the American public that the banking sector is stable. Now, consider this a preview because we're going to be getting a full report from both Barr and Grunberg on May 1st. So this will be a taste of what to expect, but obviously still ongoing reviews at the moment.
And some grandstanding, too, we can expect on the other side. I'm going to, we need a drinking game for every time they say, how did this happen?
Oh, yes.
One of the senators say that.
It's like I already answered that question actually before in my prepared statements.
Yeah,
Exactly.
they're still gonna
do
ask
it.
it.
Yes,
Yeah,
theater runs abound in Washington D.C. Thanks so much, Rochelle. You're going to be tracking this. This is going to be happening during the 10 a.m. hour and of course overflowing as well. Plus we've got some conversations. We're going to continue this conversation actually live from Washington D.C. We've got the Minnesota Senator Tina Smith, no relation, coming up in the next hour. You don't want to miss it. Plus, after the break, how are consumers feeling about the current state of the economy? We're going to pulse check. That's next.
Welcome back to Yahoo Finance Live. I'm Julie Hyman with Brad Smith. We've got data out from the Conference Board, consumer confidence for the month of March, rising slightly to 104.2, up from 103.4 in February. So a little bit higher here. And basically, the Conference Board is saying this is based on consumers' assessment of current business and labor market conditions. I should say that's the present situation index. That actually fell. It was the expectations index that went higher. So that's quite interesting. At the same time, the Conference Board pointing out for 12 of the last 13 months, that expectations part of the index has been below 80, the level which often signals a recession within the next year. Also importantly, look at this consumer survey is the timing of it. The cutoff date was March 20th. That's about 10 days after we had the bank failures. So reflects the concern around them, but maybe had died down a little bit. But quite interesting here to see a little bit of an increase in consumer confidence.
Yeah, they did say, however, for 12 of the last 13 months since February 2022, the expectations index that you were mentioning, that has been below 80, the level that often signals a recession within the next year. Cutoff date, as you were mentioning, March 20th there. So that is going to be interesting as we move forward. But I think for what we've heard from the Fed's reaction and what we'll continue to hear in even hearings taking place today, it's largely also going to be a conversation that comes in tandem around what the employment situation looks like, because consumers who are looking across employment and saying, okay, well, I'm making more than I was before perhaps, and there's still more jobs out there should I decide to change over. There's confidence that could come along with that on the consumption side of the equation as well.
Yeah, we'll see if that's what ends up happening. Of course, a big part of confidence also has to do with what has happened in the banking system. And the first hearing over the collapse of Silicon Valley Bank and Signature Bank, it's underway. 3 regulators are facing the Senate Banking Committee, and Yahoo Finance's Jennifer Schonberger has the details on what this hearing is going to look like. Good morning, Jen.
Good morning, Julie. More than 2 weeks after Silicon Valley Bank collapsed, causing shockwaves across the banking sector and financial markets, regulators will testify before the Senate Banking Committee this morning on why Silicon Valley Bank failed and what can be done to protect a situation like this from happening again. On the hot seat this morning, Federal Reserve Vice Chair of Supervision Michael Barr, FDIC Chair Martin Gruenberg, and Treasury Undersecretary for Domestic Finance, Nellie Lang. In testimony released Tuesday, Barr says SVB's failure is, quote, a textbook case of mismanagement. He says the bank's management did not effectively manage its interest rate and liquidity risk, and that the bank suffered an unexpected run by its uninsured depositors. Quote, the bank waited too long to address its problems, and ironically, the overdue actions it finally took to strengthen its balance sheet sparked the uninsured depositor run that led to the bank's failure. The picture that has emerged thus far shows SVB had inadequate risk management and internal controls that struggled to keep pace with the growth of the bank. Now, Barr admits that regulators spotted the issues leading up to SVB's failure, but that regulators need to ask why the bank was unable to fix and address the issues. He says it is not the job of the supervisors to fix the issues, rather senior management. Now, FDIC Chair Martin Gruenberg will tell senators that the FDIC will review the deposit insurance system and release a report by May 1st, including options for deposit insurance coverage levels and excess deposit insurance. He says the regulation of banks with more than $100 billion in assets merits serious attention, including capital, liquidity, and interest rate risk. Senate Banking Committee Chair Sherrod Brown says in his opening statement, quote, the officials sitting before us today know that their predecessors rolled back protections like capital and liquidity standards, stress tests, brokered deposit limits, and even basic supervision. They greenlighted these banks to grow too big, too fast. Barr, who is conducting a review of SVB's failure due out May 1st, will suggest improving capital requirements and requiring large regional banks to hold more long-term debt to act as a cushion to absorb losses in times of stress. This hearing getting underway right now, and I will monitor those headlines as they come. Back to you.
All right, thanks so much. Yahoo Finance's own Jen Schonberger, appreciate the update, and we'll be tracking any of those updates that come from the hearing With the banking turmoil hearing underway, lawmakers are weighing whether raising insurance limits on deposits could prevent more trouble down the line. Joining us now to discuss further is veteran business columnist Joe Nocera. Joe, great to have you here with us this morning. Do you believe that that is one of the easy, low-hanging fruit? And I say easy and low-hanging fruit kind of with air quotes because it is quite difficult to actually get that through at the end of the day.
Yes, no, it's totally true that it's hard to get it through. But I actually think that you could have a system where you insure all deposits, and you would prevent bank runs. They would go away because so much of the banking system depends on psychology, and if people think their bank's in trouble and they make a run on the bank, there's no bank that can survive all of its depositors taking its money out at once. So, it's been suggested by several people, several academics and others, that a way to solve the problem is to give deposit insurance to all deposits, no matter how big. And I actually think it makes a lot of sense.
On the other hand, Joe, it's Julie here. Thanks for being here. On the other hand, there are some who say, that would encourage risk-taking behavior if you just said, okay, everything's insured from henceforth. Do you think that's the case?
I don't. I mean, we already have a system where every time one of these things happen, going all the way back to the S&L crisis in the 1980s, whenever it happens, the government says, oh, it's an emergency, so we're going to insure all deposits. We don't want our depositors to lose any money. And that's what happened in this case. So there are people who had, millions and millions of dollars in the bank in a deposit. They were using it for payroll and other things. And the government said, you're not going to lose any money, don't worry. And that's what happens every time one of these things happens. So why not just, say, be done with it? And the truth of the matter is the risk. I mean, look, Silicon Valley Bank proves that you can take stupid risk with uninsured deposits. I mean, they prove it. And, the risk that these guys are taking really now comes down to the risk that they're going to lose their jobs, the risk that shareholders are going to be wiped out, the risk that bondholders are going to be wiped out, and the risk that their bank will be taken over by another bank. Those are the risks. In the world that we live in right now, there is very little risk associated with deposits.
So in talking a little bit more about the risk of your bank getting taken over by another bank, what also comes time and time again when this does happen is you have some type of fire sale that gets to go through just to save any type of confidence in the system, but also for the deposits or for the loans that bank is responsible for. And that gets absorbed by usually some larger bank, and that large bank that is probably too big to fail just becomes even bigger. So what are we to make of that side of what takes place after these crises time after time again?
Well, I mean, this is the way government has dealt with banking failure, really, practically going back to the Depression. You get a big, healthy bank to take over a struggling bank that, excuse me, that is at risk of failing, or indeed has failed. Now, in the case of Silicon Valley Bank, their loan portfolio was not the problem. They made good loans. Their problem was they mismanaged their internal risk with their bond portfolio. And so the bank that's the First Citizen that's taking over SVB, they're getting a really good loan portfolio that's going to make them some money. Now, it doesn't always happen that way because there are times that banks get in trouble because they make horrible loans. You can go back to the Penn Square fiasco and so on and so forth. But as a general rule, the big bank that takes over not only takes over the deposits and gives confidence there, but they take over the loan portfolio and give confidence to the borrowers.
And what are some of the other things, Joe, do you think that could, as you say, whenever these crises happen, you sort of look back, you try and figure out what to do. Besides the deposit insurance changes, they're doing this hearing right now. We see Sherrod Brown posing some questions or just talking. What do you think is going to come out of this besides that? Are there going to be some other measures that you think regulators are going to come in with here?
I hope so. Look, I was sort of stunned when Michael Barr said it's not our job to fix the problems, it's only our job to point them out. If JP Morgan or Wells Fargo had a systemic internal problem that was caught by the regulators, there's pretty much no way the regulators would say, boys, fix it. We'll see you in 6 months. I mean, that just wouldn't happen. So, I think you have to bring back the stress test. SVB, got that exemption from the stress test, as all those banks that size got. And I think they need to reimpose the sensible regulations that had been imposed after the 2008 financial crisis. Honestly, I think a lot of these problems could have been avoided with the regulations that had been put in place.
Right, that were then rolled back several years ago.
Right.
We'll see if that comes up today. I imagine it will, at least on one side of the aisle.
Yeah, maybe 100 times.
Yeah, veteran business columnist Joe Nocera, great to get your perspective this morning as we monitor this hearing. Thank you, appreciate it.
Thank you, thanks for having me.
We're watching a trending ticker here. It's PVH, the maker of Calvin Klein and Tommy Hilfiger clothing. It's beaten the street with its latest results. The shares are up by almost 19%. And the company also says it will accelerate the growth of those two brands in particular, despite the macroeconomic environment. Fourth quarter revenue rose 2% on the year to just under $2.5 billion. The company's CFO says PVH is well positioned to achieve double-digit EPS growth this year. Say that 5 times fast. Coming up, why our next guest says recent events solidify a recession as the, quote, most likely outcome for the U.S. We will find out why. About 45 minutes into the trading session, let's do a quick check of the market sponsored by Tasty Trade. We've got the S&P unchanged, and the Nasdaq down about 0.4%, the Dow gaining a little bit of ground, about 0.3%. So some indecision here as we continue the debate over where the Fed's going to go with rates here, and we see a split in the sectors in the S&P 500 that we were talking about earlier. And investors continue to face a series of headwinds with concerns over the banking sector, uncertainty over Fed policy, ongoing economic headwinds still weighing on sentiment. Our next guest warns that with the latest events, a recession still remains the most likely outcome for the economy in the next year. Deutsche Bank Securities Chief U.S. Economist Matthew Lazzetti is joining us now. Matt, it's great to see you. So even though you're going to bring us bad news, I guess it's great to see you.
Sorry about that.
You guys were one of the early ones to say that a recession was indeed coming. And it sounds like you're still of that view. Has anything changed in terms of when it's happening, the severity of the recession, et cetera?
Yeah, so when last April we had this view that the economy would enter into recession, it was always the second half of this year story. And the underlying kind of fundamental story from our perspective was that the economy had a lot of momentum. Inflation was very high and persistent. The labor market was very tight. And that was going to push the Fed to move very aggressively. And once the Fed moves very aggressively, it's very difficult to achieve a soft landing in that environment. And so I think we've seen a lot of that play out. I think the incoming data that we've seen from the economy so far has been resilient to start the year. We've seen an acceleration in growth, the labor market. Inflation's remaining very high. We saw consumer confidence this morning. That's resilient. But we are also seeing how Fed policy tightening is working its way through the system. And I think the most clear recent example of that is through bank lending conditions. And we think that helps to amplify Fed tightening over the next year, bringing about the eventual recession in Q4.
And so does that start to then show up? Does the effects of a recession start to show up in their two benchmark areas that they're tracking, especially employment, where people are saying, okay, if there is a recession coming, what's that mean for my job at the end of the day?
No doubt. The Fed is focused on getting inflation far below where it is today, much closer to 2%, and they're focused on achieving kind of maximum sustainable employment. And they think the labor market, to use Chair Powell's words, is extremely tight at the moment. Both of those tend to be lagging indicators. So we would tend to see things hitting the economy earlier, whether it's in confidence or in jobless claims, or in consumer spending. So far, we're not seeing that play out, and I think that's really important from an economic perspective. We've seen a lot of volatility in markets. We've seen turmoil in the banking sector. We haven't seen any of that play out into the data yet, and we haven't really had much evidence about how much bank lending conditions are tightening. So all that we need to learn over the next few weeks and months. And from our perspective, really what it's done is it's kind of solidified the conviction in recession. It has led to risk that it might be a bit earlier than what we thought before. But trying to calibrate exactly the impact of the shock right now is very difficult.
Well, it seems like Fed Chair Powell is also grappling with some of those same issues. Dig into the bank lending conditions a little bit more for me and talk to me about how that plays out as in slowing down the economy. How does that work? How does it work its way through the system?
Yeah, I think Chair Powell's comments last week were really interesting. We always talk about financial conditions and financial conditions indices, but most financial conditions indices don't include bank lending conditions. In our research over time, we've tried to emphasize bank lending conditions matter. They matter a lot. The Fed has the senior loan officer survey that I think will become increasingly important, that we'll get the next reading in early May. And that tends to be a very good leading indicator for a few aspects of the economy. Business investment, CapEx, corporate profitability, and also loan growth that we see. So where you would expect it to feed through is through the corporate sector, most likely, through likely a contraction in loan growth that takes place, through some retrenchment in CapEx that takes place. And as that happens, to your previous question, you're likely to see the labor market loosen more materially as that happens. So
just to put it really simply, if I as a company can't borrow as much money, I can't spend as much money. I mean, that's basically what it is, right?
That's the simple channel, absolutely.
Okay, and so within this, I mean, so many companies are trying to figure out not just how do we right-size our business, how do we get through a recession, and the equities market's trying to price that in advance as best as possible. But from an economist's perspective, if you were telling a CEO how they should be positioning themselves or even bracing for the impacts of a recession, what would be the word of warning to them?
Yeah, I think we've been in this very unusual environment. I mean, we called for a U.S. recession last April, so almost a year ago, but it was always an 18-month ahead story for us. It's a very unusual position for economists to be in, to be calling for a recession that far in advance, but it was driven by how far out of balance the economy was and inflation was. And so to a large extent, this is maybe the most anticipated recession that we've seen. We've heard it through I think, corporate quarterly reports and calls. And so I think you've seen right sizing taking place. Recessions tend to be these nonlinear events, so it's always really difficult to exactly, I think, gauge yourself where you should be. But to a certain extent, I think that should help to moderate the eventual impact. We're only looking for what is, I would call, a moderate recession. It looks like the early 1990s.
And do we see corporations sort of preparing in that way because we have been talking about it for a while?
In the macroeconomic data, limited. Certainly there's a lot of headlines about layoffs that are taking place, but a lot of those layoffs are concentrated in those sectors and businesses that hired a lot, that they were well above the pre-COVID trend. When you look at the broader labor market picture at this point, there's very little evidence. You look at jobless claims as of last week, initial jobless claims below 200,000, well below where we were pre-COVID. Labor demand looks very strong. So there's churn taking place in the labor market. There's some weakness in some certain sectors. But I don't think there's really much evidence so far that it's a macro story.
The conversation and the response that we've continued to get was, if the Fed were to cut at any term in the near future, then that would signal that they're seeing something much more dire than even the base case of a recession that we're talking about right now and the effects leading up to that. What do you think that would even look like if they were to see something in the data that says, okay, we absolutely need to cut right now?
Yeah, we do think it was one reason, probably likely, why they did raise rates last week. And Chair Powell was clear that there was some discussion about it, but that there was a very strong consensus to raise rates. But there's certain areas where the Fed probably has an informational advantage, and where they should have some advantage is in assessing the banking sector, deposit flows. They're seeing more high frequency data than what we're seeing. And so we were concerned that if the Fed did not raise rates, that it would exactly send that very negative signal. I think what we heard from Chair Powell last week so far was, look, aggregate deposits have stabilized. We saw that in the data last week. But that there's a lot of uncertainty about what the impact on the bank lending channel is going to be. And so I think they did the right thing, which was to say, drop forward guidance. They're far more data dependent. They still have a tightening bias. We expect that they raise rates again in May. But we're in an environment that's clouded with uncertainty, and so don't provide a lot of forward guidance about where they're going.
Deutsche Bank Securities Chief U.S. Economist Matthew Luzetti. Matt, thanks for taking the time here on the set with us.
Thanks for having me.
Absolutely. Coming up, everyone, e-commerce overhaul. Alibaba rising after announcing plans to split its business into 6 divisions. We've got the details for you next. Shares of Alibaba, at least the U.S. shares, BABA, you're seeing them higher by about 7.8% today, getting a boost after the Chinese e-commerce company announced plans to split the company into 6 divisions and explore separate initial public offerings for each. Joining us now to discuss is MacroLens Managing Principal, Brian McCarthy. Brian, great to have us here with you. First, just want to get your reaction to this, and especially considering that this is an international business and it really comes down to where some of these different businesses will ultimately find their either headquarters or find their core operations resuming or continuing to move out of.
Sure. So never a dull moment in China. A very interesting announcement by Alibaba this morning. And of course, it comes a few days after Jack Ma reappeared in China. I don't think those two events are unconnected. We could unpack that. This is going to continue to be a dominant e-commerce services company in China. But I do think that the 6 units, it looks like now smaller businesses in very, very competitive marketplaces. So the big picture question here, I think, is the degree to which these units will remain cooperative in terms of the sharing and utilization of data to build market power. I think that's really the big issue.
Well, and Brian, is the issue also what is China's interest? I mean, presumably, I think we can assume that the CCP, the Chinese Communist Party, had a hand in this announcement in some fashion. You can tell me if that's correct. And then, if that is the case, what would have been the motivation for that from their perspective?
Sure. So this goes back to November of 2020 when the so-called tech crackdown started with the cancellation of the anti-IPO, which was perceived to be in response to Jack Ma publicly, criticizing the policy direction of the Chinese Communist Party. But the bigger picture issue they're dealing with is the utilization of data to build market power and political power. So if you look at the big tech companies in the US, Alphabet and Meta and Apple and Amazon, they have accumulated incredible market power through the use of data, but it has actually morphed into political power, which is completely unacceptable from the Chinese perspective. So that was never going to be allowed to happen. And I do draw the conclusion from the coincidence of Jack Ma's reappearance in China that there's been some kind of rapprochement. They've made an agreement. Now, when you make a deal with the Chinese Communist Party, clearly they are a very powerful negotiating partner. So you can assume they had some leverage to yield and got what they wanted. So what they want is an entity, and this applies to Alibaba as well as the other large tech firms in China, entities that do not utilize the accumulation of data in a way that threatens the Chinese Communist Party's position in any way, shape, or form. So that data will reside with and be controlled by the Communist Party of China. So when it comes to the sort of the market ramifications of this division of the company, I think we can assume that while people are drawing comparisons to the holding company structure of an Alphabet, for instance, that Alibaba, I don't believe, is going to be able to enjoy the synergies that come from using cross-pollinating the data they collect across these divisions. So if they're not able to do that, then yes, it's possible that this new structure will unlock some shareholder value. The sum of the parts might be more valuable than the whole, but we need to keep perspective that the whole, as it was valued yesterday, was extremely depressed. Since this tech crackdown started, they've wiped out several $100 billion of value for Alibaba's shareholders. And unfortunately, I think that loss of shareholder value will largely be locked in by this move.
What does the Alibaba split signal, if anything, for other related stocks, such as that of a Baidu, such as that of a JD.com even, or a Tencent Holdings?
Yes, I think it indicates that their value should and will remain depressed relative to international peers that have greater degrees of freedom of how they can utilize and monetize the data they collect. So I unfortunately think it will require investors to look at Chinese tech sort of as a more prosaic industry than we're used to thinking about tech firms, which are very powerful, very high growing, and have all kinds of dynamic synergies they can create through the use of data. If that's missing in China, these companies will be valued at a significant discount to global peers. And then you look at an environment where the economic backdrop is pretty negative in China as well. And there are cyclical issues that these companies are going to have to deal with as well.
At the same time, of course, the U.S. tech giants are under scrutiny here as well. I mean, leaving TikTok aside for a moment, but Meta, et cetera, are also under scrutiny. Will they be sort of disadvantaged versus the Chinese peers if there is some sort of regulatory action against them, or are they sort of on even footing because there's already a lot of attention on these companies in China?
Sure. I think the Chinese government is much more effective in making their wishes known and felt across the system than our government is at times. So we're debating this in Congress. There's lobbying going on. There's debate on both sides of the issue. U.S. tech companies are able to, express their First Amendment rights, whether that is through, communications or the lobbying expense, and get their side of the story out there. So it's a much more balanced process, let's say, than in China, where a decision gets made at the top and it gets enacted. You can lobby all you want, but if you lobby too much, you're going to end up like Jack Ma did, in exile for a couple of years.
If you're a customer of Alibaba and say you're a small business and you sell some of your third-party products on perhaps their e-commerce site, and then you also buy into whatever their cloud services are as well, or perhaps you pioneer, or not pioneer, but you offer some type of payments through one of their payment subsidiaries. All of these things considered, you've now just become a customer of 3, maybe 4 different businesses now, not including even their local services group. So all of that, your customer experience probably just got that much worse. But at the same time, it's who are you expecting to have to communicate with for that kind of single source of information at the end of the day?
Yes, it's a different customer experience for sure, and there might be some dislocation on the customer side if these businesses really become to be run separately. But then it also undercuts the power of the organization relative to the customer. It's early days here. We don't know exactly how this is going to play out, but I think theoretically you could also say this will lead to a less anti-competitive, less monopolistic structure as far as the users of these tech services go. So I think you're right that there'll be some dislocation, certainly, but I think part of this from the government's perspective is, there are antitrust issues that need to be considered here, and it could create a more competitive marketplace. But then again, you have these from the perspective of the Alibaba equity valuation. These are going to be, if they become real 6 standalone smaller companies, some of them are in very, very highly competitive marketplaces. So that is to the benefit of the end user, to the detriment of the company if it plays out that way.
Brian, thanks for your perspective on this as we try to wrap our heads around what's going on. Brian McCarthy, Managing Principal at Macro Lens. Appreciate it.
Thank you.
Coming up, we'll bring you Brian Sozzi's interview with BMO Capital's Simeon Siegel from Shop Talk in Las Vegas. They talked about how retail customers are navigating their current market. That's next. Although consumer confidence rose slightly for March, shoppers remain wary of an impending recession that we've talked about a lot. At Shop Talk in Las Vegas, Brian Slasey caught up with Simeon Siegel, BMO Capital Markets senior analyst, for a check on how retailers are feeling right now.
I think the beauty of these conferences are they are in person, and this isn't the first one we've had since COVID, but still feels like you can see the excitement. That's interesting when you think about who we're dealing with. We're dealing with retailers. So these are people that need this. And so I think the nature of these conferences, there's a lot of buzzwords, whether it's AI, whether it's supply chain, whether it's more AI, right? It keeps on going where you're trying to figure out what's the next greatest thing. I think what you and I want to know is, what are the companies doing, right? At the end of the day, the next greatest thing will only matter if you can get the product and you can forecast supply demand. So it's interesting seeing the dichotomy of where people are going. The mood overall seems pretty positive. I just can't tell if it's because we're in Vegas.
You cover, 26 companies?
Who's counting?
I'm counting, because as you talk to these executives at these companies, what's their mood? We are living through some form of banking crisis, whatever it might be. Are they seeing a pullback in sales and weaker profit margins?
So I did a panel here yesterday. The first question was, 2023 is the year of, and to make it fun, there was a list of words, taboo style, that you couldn't say. My word was divergence. I think right now, by the way, and I thought it was really clever, and everyone's like, it's kind of a boring word, but right now, you've had years where you couldn't get product you wanted, right? You and I talk about this all the time. It is hard to be a retailer. You have to predict demand. For the last few years, you had to predict supply, and that was impossible. We're back to being able to get the product that you want, which means now it's your job to make sure you're buying the right stuff. And so when I talk to different C-suite, when I talk to different companies, I think the mood is, the future is now back in my hands. Now, this is pre-recent financial conversations, so I think people are still trying to absorb what changes for them, if anything. But the mindset of, I am running a retail business or a brand, it's my job to know my customer, I'm finally able to do that. Those that are comfortable feel like they're going to make it through. It's not going to be easy, they're going to make it through. Those that are not are discounting.
Because what we are seeing in the economy right now, do you expect a more promotional spring selling season?
I do. I think that, for better or worse, the flip side of the supply chain conversation is there's a lot of savings coming through. A lot of companies expect a lot of margin savings because it costs them a lot less to ship a couch over a container over the ocean. I think the problem with that is when you're given savings, you tend to spend them. The easiest way to spend them is with promotions. And so what I fear that everyone thinks this is going to be a great margin year because of supply chain benefits. I think what they're going to end up doing is go back to the cookie jar and use that to discount. I think if you're a consumer, expect deals. I think that's where the divergence comes in. For better or worse, John Idle, CEO of Capri, has made very clear he's not going to promote. Tapestry has made clear they like the brand equity that they have attained. Others, not as much.
Out of that list of 26 companies you cover, one is Gap. Now, in this promotional environment, what happens to a company like Gap that has been struggling for 25 years?
Yeah, so Gap is an interesting one to bring up because it's a great segue. Because Gap just reported earnings, told us that they had over 500 basis points, 5 percentage points worth of margin benefit from supply chain, improving their gross margin. Do you know what their total gross margin was? Down. All of that savings was netted out via discounts. They need to bring the Gap brand back to its power. Otherwise, it's going to be this ongoing promotional decline. I think listen, what Gap brand, you and I had this conversation about Victoria's Secret a long time ago. Brands aren't dead if they sell multi-billion dollars of revenue. That means the consumer has given you the proof of concept to say, I value this, right? A brand is as big as its revenues. It's as healthy as its margins, but it's as big as its revenues. Gap's a big brand, not very healthy. So sell less, charge more, make more money, right? That was my mantra of COVID. Most of them, we've passed through that. Gap never did it. And the issue with sell less, charge more is it needs to be intentional. If you let the revenues collapse on their own, chances are you're going to lose margin and top line. If you say, I can be a healthier but smaller brand, and I need to just focus on what made me special to whoever it is that views me as being special, we're selling apparel. This is a business that should be profitable.
Can a new CEO save Gap? Because they are supposed to get a new CEO.
Correct.
At some point.
Correct.
But the search has been, over 6 months?
Yeah, you told me you threw your hat.
No, you before me.
You're asking for the recipe
I'm not
here?
into going into sinking ships.
By the way, there's a lot of treasure in sinking ship. That's where the best treasures lie. I think that absolutely, right? But it's interesting because you asked, can a new CEO of the Gap improve, as opposed to a new CEO of GPS Inc.? I think that's exactly what they need. They're hiring for a CEO of GPS, the company. Gap, Old Navy, Athletic, it's a big conglomerate of various different companies in various different stages of their life. What they need to do is find someone who wants to improve the Gap, right? Because Old Navy's a beautiful business. Probably doesn't grow a whole lot, but it's a very big business that should have a healthy margin. The Gap is the business that needs to be focused on, needs to be turned around, and it needs to be turned around, in my opinion, not via incremental sweaters, but incremental profits.
All right, let's stay on another disastrous business that you follow. That's Peloton. You've been very right about Peloton, Simeon, really for probably over 2 years. Underperform rating still. I now see TV ads for them. The price for that bike, under $1,000. I recently got offered 3 months free because they messed up my billing. None of this sounds healthy to me.
Yeah, I think the interesting dynamic, Peloton was viewed initially as an internet company. I think you and I understand it's a brand. When brands, A, have too much inventory, or B, have too much ubiquity, they lose the ability to price. And the first sign of an eroding brand is discounting. The problem is it doesn't stop, and that's what we're seeing. And when you don't have that, the scary part, by the way, is that those price levers don't seem to be driving unit.
Well, should this be a $500 bike?
I think the bigger question, by the way, if you think about the way they're approaching this with fitness as service, is should it be a free bike that comes with an attached subscription? I think that's the way the company is viewing it. I think the answer is every single person that already has a bike, that's already paying the $44 a month, those are great customers. That's a great subscription business. Focus on them. Every incremental person that you need to drive the bike, every time you and I talk about it, I mean, we're talking about it right now, that the brand feels the need to discount. The refurbished bikes below $1,000 means they're getting old bikes. That means someone's giving them up. And they can't sell them as well as they wanted to, so they have to discount them. It's a double problem. At the end of the day, focus on the existing business. You and I have to bear hug your brand loyalists. Peloton's a good business. Peloton has created a great community. I think what it is not is a growth company.
All right, let's leave it there. BMO Capital Markets, Simeon Siegel. Good to see you in person. Appreciate it.
Brian Saz is going to keep the conversations rolling at Shop Talk with Ulta Beauty's Chief Operating Officer later on today. You do not want to miss it. And coming up, banking is front and center on Capitol Hill. We've got the latest from the Senate hearing with Minnesota Senator Tina Smith. Hey, Senator Smith. We'll see you in a second.
Credit default swaps, or CDS, back in the news, evoking memories of 2008 and the global financial crisis, as well as a Big Short movie, but we're talking about today. A CDS contract amounts to an insurance contract on a bond or a loan to protect against the risk of default. That's the credit and the default part, but we want to talk about the swap part as well, and that refers to the exchange of payments or cash flows between the buyer and the seller. Now, when the contract is initiated, the buyer will make an upfront payment plus maybe quarterly or annual installments, and the seller is only responsible for payment in the event of default. That is a credit event. It could be a missed payment on the bond, or it could be the company filing for bankruptcy. Who uses CDS? Probably not you and me, but large institutional bond managers with millions of billions of dollars invested, they of course want to hedge their risk in the market. And for you and me, quite helpful to know what Wall Street is watching and what keeps them up at night.
The Senate is focusing on the collapse of Silicon Valley Bank and Signature Bank today. The Banking Committee laser focused on the regulatory response to those collapses as lawmakers look to prevent similar meltdowns. Joining us to weigh in on the outlook for bank policy is Senator Tina Smith, Democrat of Minnesota and member of the Senate Banking Committee. Senator, thanks so much for taking some time here with us today, even as the hearing going on right now. First and foremost, of the actions that were taken in response to the collapse of Silicon Valley Bank and Signature Bank, what was your immediate reaction in that moment and your grade that even you would assess to the situation as it unfolded?
Well, I was very glad that the regulators in the Biden administration took decisive action early to contain the panic that I think had the potential to spread throughout the system, particularly to smaller banks that have a completely different and much more responsible business model than Silicon Valley Bank, for example. I think that did what it needed to do. It stabilized the system. And now what we need to do is get to the bottom of what happened. I mean, clearly there was some significant mismanagement mismanagement at these banks. I think about Silicon Valley Bank that had obvious interest rate risk. That's kind of, banking 101 to manage your interest rate risk, and also operating in a very concentrated industry, very volatile industry in tech and venture capital. But we also need to understand what was happening from the supervisors. The Fed that was supervising this bank clearly had identified problems, and I am wanting to know more about what actions they took and how the bank responded, and whether they used all the powers that they had to prevent this. And then, of course, longer term, we need to take a look at whether the regulations that we have in place for banks of this size that clearly have significant systemic risk, whether those regulations are tough enough, particularly when it comes to things like stress testing and capital requirements and so forth.
Well, and Senator, thank you so much for being here. As we have heard, in the wake of this, Silicon Valley Bank was among the banks that was heavily lobbying to not be subject to the same level of scrutiny because of its size as the 10 or 12 most systemically important banks. So was that a mistake to roll back some of those protections and some of those regulations as Congress did several years ago?
Well, look, I think that one of the things we're going to learn from this internal review of the Fed and that we have to grapple with is whether that law went too far. I offered amendments when we were passing that law back in 2018 to make sure that banks the size of Silicon Valley Bank were not exempted from those more stringent capital requirements and stress testing, and the requirement to have a resolution plan, kind of a living will for banks when they fail. So clearly back in 2018, I thought it was going too far. And now that we've seen what's happened with this bank, I think it's important to figure out whether we did in fact go too far. It kind of looks that way right now.
And so as it pertains to figuring out what happened, how is the committee also trying to understand where some of the bank failures could be, even as some have called a catalyst for an economic recession?
Right. Well, I think that's a very important question that I'm hoping to get to today. I'm going to be asking questions about how pervasive the Fed thinks and other regulators think this interest rate risk is. If you have business models and banks and other institutions that are predicated on basically free money, very, very low interest rates, what risk are those organizations at now that interest rates are higher? For example, other mortgage companies, and what risk are they exposed to? I think it's very important that we understand that, and that's the role of the committee to dive into that and figure out, even for institutions that aren't explicitly regulated by these by the Fed or by the FDIC, but are responsible overall for the financial health and stability of our economy.
Senator, I'm curious what you're hearing from your constituents, and in particular, if there are small and medium-sized banks in Minnesota that have gotten a hit because of this, right? That have seen some deposit outflows, even though we know overall the numbers are stabilizing. But what are you hearing from them?
Well, Minnesota has many, many community banks, small banks that are rooted in their communities and have a completely different business model from this highly risky and irresponsible way that Silicon Valley Bank was managed. I had a chance to meet with Minnesota bankers last week to kind of hear where they were, and I thought it was very apt that they said, Senator, if we were worried about our own banks, we wouldn't be here today. We'd be back home taking care of business. It's very important for depositors to realize that those banks that are not only smaller, but have a completely different and much less risky business model are not exposed to the same kinds of risks and challenges. And I believe that those community banks are very important to the overall strength of our banking system, because that strength comes from our diversity.
And so even with that, there have been some questions out there about the connection of some banks who had exposure as well to crypto, and saying that this was an attack on some of those banks by regulators in order to shore up the traditional finance versus the decentralized finance. What would the response from the committee be like to that?
Well, I have expressed deep concern about whether these highly risky and volatile crypto assets being held in big banks would contribute to the instability and the risk profile of these big banks. And clearly what happened to Signature Bank is a demonstration of what it could look like when you have kind of a collapse of those assets and then you have a run on the bank because people lose confidence in the bank. So I think it's very much an issue that we need to be thinking about on the committee as we are considering what kind of consumer protections we need for crypto assets more broadly.
Senator, two questions about potential changes here. One, do all deposits in the U.S. need to be insured by the FDIC? Two, do all banks, no matter their size, need some kind of stress test?
Well, I think that it is important to first of all, I think that it's very important that we don't apply the same regulatory standard for a massive, systemically significant bank that we apply to a small community bank in Owatonna, Minnesota, that has a completely different risk profile. Size does matter in terms of the risk that you might see, but it also the business model matters. So I am not one who believes that we should have a one-size-fits-all approach. However, when you look at these big regional, very, very large banks, clearly the collapse of Silicon Valley Bank shows us that even if you're not designated as systemically significant, you still can have a very powerful impact on the overall stability of the financial system. And that's why, back in 2018, I was opposed to rolling back some of those stress tests for those very large regional banks.
And Senator, finally, if I might pivot for our last question, I want to ask about the debt ceiling, because that's the other, certainly for market participants, the other big question right now. We had House Speaker Kevin McCarthy talking about this morning that there's not been any progress on debt ceiling talks. The American people, the markets, everybody wants to get this done. Members of Congress want to get it done too. Do you think we're going to get another 11th hour situation here as we have in the past?
Well, I hope not, because we have seen that when you wait until the last minute to do something as simple as the United States agreeing that we will continue to pay our bills, it has a very negative impact on the U.S. economy, the global economy, and the trust in the full faith and credit of this country. I would urge Speaker McCarthy to look in the mirror. What we need to do is to pass a clean debt ceiling extension right now. And the president and Senate Democrats have expressed an interest in then having a conversation about what the federal budget should look like. But the speaker has still not offered up any ideas of his own or for his caucus about what that should look like, what he proposes, what cuts he would propose. And you can't have a negotiation if you have one side refusing to bring any ideas to the table. So these two things, though, need to be completely separate. Let's pass a clean debt ceiling extension, and then let's have a discussion about what the federal budget should look like.
Well, we'll see what ends up happening. We'll be tracking it very closely. Thank you so much for your time this morning, Senator. Senator Tina Smith, Minnesota Democrat, thank you again.
Thank you.
Well, we've got much more to come in our next hour. We're going to continue our coverage of that Senate banking hearing, taking a deeper look at the role that regulators played in SVB's sudden collapse.
Plus, gold's glow up with recent market turmoil. A strategist joins to discuss the appeal and the limits of the safe haven.
Also, Oscar Health's new CEO joins Yahoo Finance with this outlook for the health insurance company's future. Mark Bertolini, who ran Aetna, who was co-CIO at Bridgewater. Really interesting there. Oscar seems to be bringing in the big guns here to try and maybe turn things around there. So it should be interesting.
We'll see if it works.
Yes, we will. All right, let's take a last look at the market, shall we? Before we leave you, we've got a mixed picture here. The Dow's the only one in the green, and very barely here. The Nasdaq leading declines down by about 0.9%. Rochelle's got you for the next hour trading. We'll be back tomorrow.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. The rate debate rolls on. Swaps traders are pricing in a 50% probability the Fed will lift rates by a quarter point in May. BlackRock taking a firm stance, arguing the banking sector woes won't stop it from continuing with rate hikes. And Alibaba is breaking up. The e-commerce giant announcing its $220 billion empire will be divided into 6 main units. The move comes just a day after the company's founder Jack Ma resurfaced in China after months of absence. And facing the fire. The first hearing over the collapse of Silicon Valley Bank and Signature Bank is underway as 3 regulators face the Senate Banking Committee. We break it all down for you next. But first, let's check in on how the major indices are faring. We're seeing some selling action picking up here. It's a mixed picture. We see the Dow there up just very slightly, though, about 13 points on the day. The S&P there also way down. They're down 14 points, about 1/3%. Tech-heavy Nasdaq taking the biggest hit so far on the day, near the lows of the session so far this morning, down 105 points so far. Let's also check in on the action we're seeing with the Treasury market as well. We're seeing some of this risk sort of going away here because we're seeing Treasury yields, especially the short-term yields, really seeing a jump there. We're seeing the 5-year up about 1.7% on the day. The 10-year, obviously the most interest rate sensitive, that's also up about 1%, and the 30-year up about 1/3% as well. Well, let's continue our coverage of today's top story. The Senate Banking Committee holding its first hearing on the recent bank crisis caused by the collapse of regional banks Silicon Valley Bank and Signature Bank. Here with more, Yahoo Finance's Jennifer Schonberger. Hey, Jennifer.
Good morning, Rochelle. That Senate Banking Committee hearing with regulators on why Silicon Valley Bank failed underway right now. Out of the gate, lawmakers had searing comments for witnesses. Chairman Sherrod Brown said he wants to propose legislation that will better enable regulators to reprimand executives. Take a listen.
It will surprise no one in Ohio that these bank executives face less accountability than a cashier who miscounts the cashier's box, the cash box. That's why I'll be introducing legislation to strengthen regulators' ability to impose fines and penalties, to claw back bonuses, to ban executives who cause bank failures from ever working in another bank.
Republican ranking member Tim Scott also had searing comments saying, quote, "This is a classic tale of negligence, and it started with the banks themselves without any question. That's where the buck stops. So it is imperative that we hear straight from the horse's mouth, so to speak, to find out why these banks were so poorly managed and so poorly managed the risks." Now, the Fed Vice Chair of Supervision, Michael Barr, said SVB failed because the bank's management did not effectively manage interest rate and liquidity risk. He said that the firm was rated 3 on a scale of 5 being the best, meaning that it was not well managed and that it rated deficient at a company management level. He also said the Fed is going to be thorough and overreaching in its own review of itself to see where it fell down on the job. Now, FDIC Chair Martin Grunberg said their central concern when SVB failed was that the evidence suggested there was significant risk of contagion, and that is why they swooped in with the actions that they did so swiftly. He said over the weekend there was serious stress at other institutions and the knock-on effects of that contagion, and that is why they did what they decided to do. He said had they not acted, the situation would have been much worse. Now, for her part, Under Treasury Secretary Nellie Lang said that regulators are prepared to take the steps they already did to better protect depositors if there were to be more future runs. This hearing underway right now and ongoing. I will bring you those headlines as I get them. Back to you.
All right, appreciate it there. Jennifer Schonberger there for us. All right, let's continue our conversation now. Joining us, John Sedunov, Associate Professor of Finance at Villanova University. So obviously today we're going to be seeing a lot of finger pointing here, but should regulators have really foreseen these bank collapses?
Hi there. Well, thanks for having me. Regulators probably should have seen this coming. When you look at annual filings, quarterly filings from the bank, the interest rate risk on the balance sheet was apparent. And the fact that the institution didn't hedge this risk also should have been apparent. So, it's a little bit concerning that regulators probably observed these things and chose not to act, or at least from what we can gather, chose not to act. And it will be interesting to see how it plays out here to understand better what they did or did not do as they observed these things unfold in the months before the failure of the bank.
And as you mentioned, that months before the failure, we already knew that interest rates were rising, that there was a disproportionate interest rate risk to these particular banks. Then in terms of some of the existing legislation that's out there, could anything have prevented this?
It's not necessarily clear that it totally would have. I think if you think about things like capital requirements that are oftentimes things that we care a lot about, think about liquidity ratios that banks are subject to dealing with, likely SVB would have been fine along these lines. When you start to build in then the fact that they have losses on the held to maturity portfolio that they weren't expecting to have to sell away, but eventually you have these depositors who are fleeing the bank that force them to take losses in that area. These losses become apparent. The weaknesses become a little bit more apparent. But at its face, when you think about the stress testing that the bank would have had to deal with, capital requirements, liquidity ratios, likely, again, mostly fine as far as the headline stuff. So you kind of probably need to dig in a little deeper than just the top line items to really understand the bank's situation.
And we know that there have been a lot of comparisons to 2008. And you said this isn't the same sort of systemic risk. This disproportionate exposure that Signature and SVB had really does differentiate it. But when you look at some of the factors that led up to it, what sort of reforms could really affect this? We saw the reforms that happened after 2008. What would really help in this situation?
Right. And when we think about reforms, when we think about regulation that happens after a crisis, it's typically we're fighting the last fire and not always looking forward to the next one. So after 2008, it's all about liquidity and capital requirements. Stress testing becomes a big deal. Now, I think you have to start to think about a little harder about liquidity ratios as it relates to the bank's deposit base. Banks that have less stable funding, banks that have deposits that are more likely to be, coming and going from corporations, less sticky. When you have those kinds of situations, you have to think harder about what the liquidity rules are going to tell you and to be prepared for a potential outflow of deposits. From the interest rate risk side, it's a little less clear to me because, again, when you think about interest rate risk, this is a textbook thing that banks should be able to manage, and most banks do manage. And so, there can be checks and guardrails as far as increased scrutiny of banks' hedging practices as it relates to interest rate risk. But at the outset, this is something that should have been done in the first place.
And John, I also want to ask you about the aftermath. Now, we know that the deposit insurance fund, that's pre-funded, that banks pay into this. But a lot of people wondering why the OLA, the Orderly Liquidation Authority that comes under Dodd-Frank, why that wasn't used instead of the Fed sort of essentially just backstopping these banks?
I think that's a good question. But when you bring in the Fed and when you think about the potential for a larger scale situation, having the Fed come in to backstop institutions and other regulators serving in similar capacities, I think the idea here is to stop the bleeding and to give a signal of strength in the financial system. I don't view Silicon Valley Bank or Signature Bank as a bank that's interconnected, that their risk and their spillover of their risk is going to cause others to fail directly, like maybe you would have had in 2008, like we mentioned before. But panic can be contagious. Even if other banks are fundamentally very sound and very healthy, panic can be contagious, and panic doesn't need a fundamental reason. And so when you have the Fed step in as a backstop, when you have the FDIC guaranteeing non-insured deposits, it's all there to help solidify the banking system, to give confidence to depositors and keep things as stable as possible. And so far, it seems generally that's been working. It's not out of the possibility that we see another bank fail. I don't, though, foresee widespread contagion and multiple banks failing. And in part, that's due to the role of the regulators and what they have done to kind of backstop the system.
And you mentioned it's more so the panic that had the systemic reaction versus the actual banks themselves. Is there anything you think that lawmakers will say today that will really solidify some confidence in the banking sector when you really do have some of this panic that's still making its way through the system?
That's a good question, and it's really hard to say because I think what we're going to see in the hearing here is actually stuff that could potentially make people a little bit more uneasy as you're kind of going through why all this happened and exposing some shortfalls in the system. I think regulators have to be careful about what they say, and we saw Janet Yellen make comments that were somewhat at odds with themselves over the past few weeks about who's going to be bailed out, what depositors and what banks would or would not be. And in some cases, I think those comments eroded a little bit of trust in medium or regional banks, even smaller banks, and led to more of a deposit flight to larger institutions. So regulators really do have to be careful about what they say as a result of this crisis. And again, what you say contributes to panic or lack thereof. And so it's paramount that they are careful about what the message is at the end of the day.
Indeed, we know people will be passing through the testimony that we hear today. John Sedanoff, thank you so much. Associate Professor of Finance at Villanova University. Thank you for your time this morning.
Thank you.
All right, turning now to our trending ticker. Walgreens rising after reporting a beat on estimates. The health-focused retailer seeing its business accelerate in February, with its healthcare unit helping offset a drop in demand it's seeing as COVID-19 cases and demand continue to wane. Walgreens reporting a decline in both vaccinations and testing. This, of course, leading to decreased foot traffic in its stores. All right, coming up, Alibaba has announced its biggest restructuring of its 24-year history. But what does that mean for Jack Ma's company? We break it down for you next. Alibaba announced that it will split into 6 separate units, its biggest restructuring of its 24-year history. Now, this comes as the current Alibaba CEO, Jack Ma, suddenly resurfaced in China after a year-long absence. For more on this, let's welcome in Thomas Hayes, Great Hill Capital Chairman and Managing Member. Good to have you, Thomas. So, a little bit unexpected. I mean, Jack Ma just now resurfaced in China, and now seeing this split into 6 units, each will have its own CEO, its own board, potential for IPOs. What are your big takeaways from this move?
This is an historic day for Alibaba, and it's been a long time coming. This is a mechanism to unlock value for shareholders who have been patiently waiting for months and months and months. I know as a major shareholder, and this is just huge. So if you look at the 6 parts, Rochelle, just take the Ali Cloud business, the Aliyun business, okay? This business did $11 billion of revenues last year. McKinsey expects that the cloud business as an industry will triple by 2025. So let's put it at 30, 35. They currently have 38% share of the entire market in China right now. So at 30 billion, the operating margins will expand to probably about AWS range, mid to high 20s. So you're looking at $10, $11 billion of operating income with a fast-growing business. They're going to throw the AI business into the cloud business. So then you apply a normalized 20 times, 25 times multiple. You've got a $200 billion business just in one out of those 6 pieces. That's the type of value unlock that we're going to see, whether they IPO, whether they spin. It's just a monster thing. Oh, and by the way, you get Tmall, Taobao, Lazada, you get the logistics business, you get the Ellie Mae business, you get the international e-commerce business. So I think this is just going to be a monster. And every single value investor like myself, we looked at it on a piece-by-piece basis, and we said the sum of the parts is greater than the whole. Now the sum of the parts is going to be realized. And if you look, yesterday alone, the business closed at $220 billion valuation. Just that one piece can be worth a lot more.
So then, is there still an appetite then to jump in here, knowing that Chinese regulators will still be keeping an eye on what happens with Alibaba?
Well, that's another key reason. So as this huge conglomerate, they were kind of the whipping boy for the the entire platform economy. So when the regulators were cracking down, and they've eased up a bit, but now with 6 individual parts, they can kind of fly under the radar and become large businesses unto themselves, but not be this massive business that controls so much of the economy and is so much of a toll taker in China. So I think this is a good decision from an economic standpoint for shareholders. It's a good decision from a regulatory standpoint. Shareholders are going to love this. It's going to take time to realize the value, but we're off to a good start today. But I think just beginning.
All right, well, let's also take a look at the value that we're seeing in the market sentiment in US markets today. I mean, some bearishness. We're seeing this sort of mixed picture, this sort of tentativeness at the moment. What level of bearishness are we at, and is it justified?
We're at some serious pessimism. One of the things that I look at, Rochelle, is the Bank of America Global Fund Manager Survey. And this lays it out. Investment managers are more bearish than they were during the great financial crisis lows. They're more bearish than they were during the Euro debt crisis lows in 2011. I know you're too young for that stuff, but I was around. And the pandemic lows. Can you imagine people are more bearish today than the pandemic lows when we didn't know if we would have a vaccine or when we would have a vaccine? And that's where we are. Now, the recession fears, they've come off the peak a little bit, which implies that that's happened. That happened in April of 2020 after the bottom was in. That happened in March of 2009 after the bottom was in. So our base case is that the October lows are solid. They're in. We have some short-term volatility, but markets don't top. Right now, managers are overweight bonds and cash, and they're underweight U.S. equities and tech. Markets don't top when everyone is overweight bonds and cash. They top when everyone's overweight stocks and overweight stocks in a leveraged way so that there are no marginal buyers. So we're nowhere near those levels, and that's why we remain very constructive on the markets.
So then in terms of the sectors that you like, I know one of your themes is healthcare. Break that down for us. What are you seeing?
Yeah, so the Fed is basically done, even if they don't know it, or maybe one more hike if they really want to get aggressive. But in that environment where growth is moderating a little bit below trend, no more hikes, rates are going to start to come down. Certainly you're seeing it in the 10-year yield. That's a good environment for healthcare. And we like biotech. We like a basket of biotech. XBI ETF. And this reminds us a lot of the tightening cycle from 2015 to 2018. That ETF collapsed 51% because of the tightening cycle from 2015 to 2016, and then subsequently rallied as the tightening cycle worked its way through and started to end. It rebounded 135% over the next 24 months. Now, the XBI ETF from 2021 to 2022 collapsed 65%. It bottomed in May. It's been grinding sideways for about 6 months. It just did a little retest to shake everyone out. We think this is going to be constructive, and we also think we can see triple-digit gains now that the tightening cycle is ending over the next 12 to 24 months. So we think there's a lot of opportunity there, and the key drivers, Rochelle, are going to be drugs and deals, okay? That doesn't sound great. Sound great. So the drug approvals are coming in fast and furious, Alzheimer's, cancer, because the focus is off of COVID at the FDA and back onto drugs and deals. Big Pharma's got $500 billion of cash on their balance sheet, up 400% over the last 20 years. They're coming up to patent cliffs, so they're going to have to buy growth. They're going to have to buy innovation, and these deals are going to happen. Pfizer just bought Seagen for $43 billion, as you know. That's just the tip of the iceberg. We're going to see a lot more deals. We're going to see a lot more fear of loss amongst board of directors. That's going to drive the group, and it's going to be very constructive. Historically, the valuations are so low. Just to get back to the average multiple from the past 2 decades, price to book, the sector would have to go up 25%. Price to operating cash flow would have to go up over 155%, and price to forward PE up 110%. So that's in line with our expectations for the next 12 to 24 months.
So certainly plays to be made here, not just staying defensive, certainly some options on the table.
That's right.
Always good to see you. Thomas Hayes there, Great Hill Capital Chairman and Managing Member. Thank you for your time this morning.
Thanks for having me.
All right, checking back in on markets here, sponsored by Tasty Trade. Still seeing a mixed picture here. The Dow, though, the only one in the positive there, up about 55 points on the day. The S&P there still struggling, but just barely there, just down about 7 points on the day. And the biggest hits coming from the tech sector there, weighing on the Nasdaq, down about 75 points or 0.6%. All right, coming up, Oscar Health has a new CEO as it looks to turn profitable in 2023. Mark Bertoloni joins us after the break. Stay tuned. Oscar Health has a new chief executive. The health insurance provider announcing that former Aetna head Mark Bertolini will take the helm as CEO next month, where he'll be charged with the task of guiding Oscar toward profitability in 2024. For more on what's in store, let's go to incoming Oscar Health CEO Mark Bertolini, joined by our very own Angelique Kemlani. Thank you so much for joining us this morning. So talk about this decision now to take the helm of Oscar and really that plan to profitability.
Yes, it's been a journey. I've been an advisor to Oscar for the last 1.5, 2 years. And as we have worked through a number of issues that set us up nicely for profitability on the insurance company in 2023 and overall profitability in 2024, we believe that now is a good time to have Mario, who has led this organization amazingly well, focus on the tech stack, which we think is the next chapter down the road once we get to profitability, while I help lead the company and think about strategy going forward. So if there was a time in healthcare where we still need disruption, I think smaller companies focused on customer experience and moving the customer to a new place, like a lot of industry disruptors do, is a great way to think about how we look at our future as a company.
I'd love to get to that in a second, Mark, specifically the positioning of the company. But let's start off with that tech part of it, because I think that's a really interesting point. I know you're very tech forward. Mario, of course, working on that now. But he did say that you share in the vision of what is wrong with healthcare and what needs to be fixed. And I know when we're talking about technology and AI, there's been a lot of concern about what that means, especially for the insurance market. Cigna in particular, one of your old stomping grounds, coming under fire recently about the volume of denial of claims. And so I wonder, looking at where the trajectory is for technology in this space, how do we balance that where, companies, especially insurance companies, are good investments, but also balance that patient burden?
I think healthcare largely continues to suffer on a lack of a customer in point of view and the whole customer experience. And as a result, you have net promoter scores for all of these companies on the screen other than us that are near zero or less than zero, while Oscar has a 47 NPS score. That means we are valuable to the customer base. That is an opportunity to move customers to our company. And I think we have to, and what happens in the healthcare industry is we ignore the end user, the individual customer, when largely 70% of the now marketplace, when you look at Medicare, Medicaid, and the ACA, is now individual as a sale. We see individual expanding as an opportunity longer term, maybe even all the way to the point where employer-sponsored insurance is not as valuable to people as individual coverage could be. Secondly, we see more digital. If the pandemic proved anything to us, it's people's willingness and providers' willingness to work virtually. And so our virtual provider network that we have operating in a number of markets today is one that we believe we can expand beyond primary care into tertiary care. And finally, when we talk about value-based care, the value-based can't be just what we offer to the providers or how we reward them. It has to be how the customers feel about it. And so we believe that as a company as nimble as ours, with the kind of technology we have and the progress we've made on our own insurance business, that we now have an opportunity to look forward to using that technology and our experience to grow our business on the individual side, make it a customer experience that people want and will come to us versus having to acquire it in any way, shape, or form.
Well, to that point, Oscar definitely has struggled to sort of maintain that momentum it started off with, only in half of U.S. markets, as well as looking at the different segments that it's sort of jumped in and out of, including in the employer space. I wonder, where do you see this opportunity, with this push for digitization and consumerization that I know you're big on, especially what we saw with Aetna. So it's now competing with these legacy players who are sort of mimicking that blueprint. So where does Oscar fit in, and how does it grow there?
It's a lot harder to change large organizations that are set in their ways and get everybody rowing in the right direction. We don't have that problem here. As it relates to the number of markets we'll be expanding in some markets this year in the ACA. As it looks at product opportunities, we need to harden the platform so it can move to other parts of the marketplace. So we're not in a hurry to do that. We're focused about making what we have now work so that when we look at other market opportunities like Medicare and Medicaid in the future, we're prepared to take advantage of those marketplaces and provide the best customer experience versus anybody else in the field.
So you see this positioning the company as more of a competition rather than, say, an acquisition target in the future?
Definitely.
And then finally, really quickly, early on when Oscar first came on the market, I know there were many legacy insurance executives and CEOs that kind of saw this as a temporary stay. Meanwhile, they've now started mimicking the blueprint with telehealth and bringing everything in for the various segments. Were you one of those early deniers?
I was one of those early deniers, yes. But having spent time with Josh and Mario over the last year and a half talking about the business, what their goals were, where they thought the industry was going to go, I am now convinced that this is a place that can really ultimately begin that change in healthcare that we've found so elusive as an industry over the last 40 years.
And obviously, you're going to be reporting Q1 financial results after the close on May 9th. So expectations here for investors leading into this. We've already seen the stock popping, obviously, with this announcement here. But what should investors be aware of heading into this?
Well, we reaffirmed guidance today, so we're on track to deliver what we said we would deliver. We will spend some time thinking about strategy and how we're going to operate. We may have some information and news for that in May. It may take a little while longer. We don't want to rush just to meet a date. We want to make sure that we have a full and thoughtful plan when we move forward and start talking to the street. And as is my normal way of dealing with the street, we don't talk about all of it at once and so far out. We let it come out as we're able to prove the point that we're delivering.
We'll certainly be looking forward to checking back in with you. Incoming Oscar Health CEO Mark Bertolini and our very own Anjali Kemlani. Thank you both for joining me.
Thank you so much. Great to see you both.
All right, coming up, as investors search for a safe haven amid the banking crisis, they are turning to one hot commodity. We dig into the latest gold rush after the break. The search for safe havens turns to an old friend, gold. Investors taking a closer look at the precious metal as a traditional safe haven asset as bank instability, inflation, and of course rising rates add to the gloom. But is all that glitters good for investors? Here with more, George Milling-Stanley, Chief Gold Strategist at State Street Global Advisors. Good to see you, George. We're seeing gold seeing some gains today near the highs of the day at the moment. What do you attribute this to? We know that people have been looking for safe havens. Is this the moment for gold?
I think so, yeah. I think, we live in very, very uncertain times, Rochelle, and they just seem to be getting more uncertain as we go. I'm a little concerned that the markets seem to be losing their faith in Jerome Powell and what he says. Powell, I think, has made it pretty clear that he sees no possibility of a rate cut in 2023, and yet I understand that the markets right now are actually betting on a rate cut as soon as June of this year. That seems to me kind of crazy. I think that's leading to some exuberance in some sectors of the stock market, which I frankly don't think are warranted. And I think that we have a lot more uncertainty coming. And if the markets are starting to lose faith in the people who are controlling interest rates, then I think that things are just going to get worse from here. That means that more people will need more safe havens. Gold will come into its own when that's the situation.
And in terms of how it benefits a portfolio, I mean, you list a couple of things: risk management, capital appreciation, wealth preservation. Break those down for us.
Okay, look, to me, the promise of gold for investors has historically always been of a dual nature. Over time, and I think that's the only way to measure the performance of any portfolio asset, and gold in particular, over time, gold can help to enhance your returns. And over time, gold can help to reduce the volatility of a properly balanced portfolio. In other words, over time, gold can help to enhance your risk-adjusted returns or improve your Sharpe ratio, as the brokers call it. I think that that's really the key from this point of view. While it's doing all those things, it is also, as you say, it's adding diversification. And I think that this is really very important for investors. A small allocation to gold within the context of a properly balanced portfolio has always made sense as a strategic allocation. And I think from time to time, it also makes sense as a tactical allocation. I'm still looking at that one, but the strategic benefits of gold, I think, have been demonstrated many, many times and will continue to be.
I mean, and even with some volatility, gold futures still up 15% over the last 2 years. How would you compare its performance to the S&P 500 when people are trying to decide where to put their money, knowing that perhaps the returns may not be as great, though, if they're going with gold?
Look, I'm not saying that everybody should sell all of their stocks and put all their money into gold. That's absolutely not the way that we look at gold at State Street here. But I do think that a small allocation in a properly balanced portfolio can make sense. The way that I like to look at gold's performance over the 20 years or so of this century, gold opened this century at $255 an ounce. So seeing a price today of $1,965, that's a pretty good gain. That's actually somewhat better than the S&P 500 did over that same period. And I would also make the point, when you talk about volatility over time, gold has shown that it is marginally less volatile than the S&P 500. That really says something important. The S&P 500 is an index, and an index by definition is always going to be less volatile than the individual things that make it up. Gold's just an individual asset, but it has over time been marginally less volatile. It may only be 1 or 2 percentage points, but it's 1 or 2 percentage points in the right direction. If gold can reduce my volatility and has the potential to enhance my returns, then I'm going to want a small allocation to that in my portfolio as a strategic asset.
I mean, and that certainly makes sense. I mean, usually people, flock to bonds, but when you have an interest rate sensitive device like bonds, that's not the safe haven that people look to. So then in terms of perhaps any other sort of risks that do attach to gold, if it's not interest rates, what are some of the risks that people should be aware of, at least keeping mindful of when they're investing in gold?
Well, look, I think, One of the things that can happen and has happened at various points in history, not every time, but on occasion when we've had a sudden drop in the stock market, and I think if we are going to move into recession this year, which is still very much on the cards, then I think that we might well see that sudden drop in the stock market. That means that anybody who's actually bought stocks on margin is going to be faced with calls for increased margin as the value of their holdings has declined. Rather than selling out of those holdings, those investors who are savvy enough to own some gold have in the past been able to sell a little bit of gold in order to meet the margin calls on their depressed equities. But typically what has happened, and this has happened every time we've had one of these big moves down in equities, whether it's 2008, whether it's 2020, we go all the way back to 1987. We've had an awful lot of sudden moves down and gold has benefited. Initially, gold may well go down with equities on this margin call liquidation. But typically, when investors see that gold has done what what exactly they bought it for, then they will re-up their gold holdings as quickly as they can. That has generally been the case. Whenever you've had a sudden downturn in the stock market, stocks have remained depressed for months or even years. Gold typically is recovered within months or even weeks. And I think that's an important thing for investors to bear in mind. So that's one of the risks. But don't be fooled just because on a temporary basis, stocks and gold may go down together. Doesn't necessarily mean that they're correlated. I think that what we've seen in the past is that there's a very different kind of relationship. There's an asymmetrical relationship between gold and stocks. And I think that I would expect gold to get better if, as I expect, stocks will start to weaken.
And certainly an important distinction there when we do see perhaps the prices going down at the same time. George Milling-Stanley, Chief Gold Strategist at State Street Global Advisors, thank you for joining me this morning. Right, well, let's expand on our conversation about the investor search for a safe haven. As fears over a banking crisis de-escalate, investors are taking a second look at hedges like treasuries and even riskier assets like crypto. Well, with more on this, we have Alexandra Canal joining us at the moment. So, Ali, talk about some of these safe havens.
So, as you were just discussing, those traditional safe haven asset classes are largely considered gold, the dollar, treasury yields, and those are typically areas that investors flock to during uncertain economic times. And certainly after the collapse of Silicon Valley Bank, there were a lot of concerns over contagion and a full-blown banking crisis. Since that time, however, that sentiment has faded a bit, which is why we've seen a bit of a retreat in gold. Yes, it's up today, but down over the past 5 days, as well as a US dollar. But still, amid these risks in the banking sector, investors have been looking elsewhere. Julie Hyman was out with a great morning brief this morning about how big tech, communication services, IT, they are now havens for investors who want to avoid the uncertainties in financials. There is this expectation that rates will possibly go down. Even Fed Chair Jerome Powell hinted that we could be towards the end of their aggressive rate hiking campaign. That's obviously great news for the tech sector. And if we take a look at some of these tech stocks, just a big run up since the start of the year. We've seen Apple shares up more than 20% year to date, Microsoft up more than 15%, with many analysts on Wall Street saying there's even more room to run as tech becomes this new safety net for investors. But as you alluded to, Rochelle, it's not just tech. We're also seeing a very similar story play out in the crypto space. This tale as old as time when it comes to the banks going down, crypto going up. Bitcoin is up more than 15% over the past month. And about 2 weeks ago, in the immediate aftermath of this bank turbulence, Bitcoin hit a 9-month high. And to me, this is just such an interesting story because it wasn't that long ago that we saw the collapse of FTX and the ripple effect that had throughout all cryptocurrencies right now. But I do think that as investors continue to digest what's going on in the economy, continue to access all this economic data, and even what's going on with this banking crisis, there's going to be this risk on versus risk off sort of trade in the future. And the definition of what a safe haven actually is going to keep evolving and changing.
I mean, clearly, because at the beginning, crypto was like, no, that can't be a safe haven. Then it was, then it wasn't. A lot to keep up with. Thank you for breaking that down for us. Alexandra Canal there for us. All right, coming up, speaking of crypto, the ongoing bank crisis is causing some instability with the market. So should investors start to hedge the banks with tokens? Stick around as we discuss next. Digital assets increasingly seen as a more liquid way of accessing money during crises, like the one that brought down SVB, Signature Bank, and others. But it comes with its own set of risks. This as regulators take on crypto globally. Joining us with more, Sean Stein-Smith, business and economics professor at Lehman College. Good to see you, Sean. So I want to first start with the actions taken by the CFTC. We saw what happened with that Binance announcement. What is the state of play at the moment here?
Yeah, and so really, the last half year or so, it has been a total pivot on a oversight point of view, be it the ongoing Coinbase lawsuits, the Kraken lawsuits, Binance lawsuits. Pretty much every policymaker, regulator, both here in the U.S. and internationally, has moved hard, not against crypto per se, but they are trying to make crypto operators operate in compliance with the current laws on the books, but they're also doing so. They haven't quite issued crypto-focused guidance. So it's a really interesting time to analyze how these firms are going to navigate all of this ambiguity going forward.
Because we have talked about this issue of regulation by enforcement, sort of trying to figure it out. We know that we thought it was going to be the SEC making another move with Binance, but instead a different branch of government here. So how are some of these crypto companies keeping pace then when you have these changes in the US and now the G7 looking for tighter frameworks on crypto as well?
Yeah, so absolutely. I mean, for any operator out there trying to either handle customer trades, issue their own tokens, it really has been a uphill battle, and I don't think it is poised to get easier anytime soon, right? Because, as you said, there is still ambiguity as to who even oversees which types of operators, right? And this whole regulation by edict or by court case is a real problem, right? Because from a business planning, business continuity point of view, it's almost impossible to plan, invest, or to actually create products and services in compliance if those rules are not clear up front.
So then what does that mean if you are someone who invests in crypto and you're trying to manage this and your taxes are coming up? How are you supposed to manage that with all these new regulations?
So it's a really interesting point there, right? Because on the one hand, there are these onslaught of lawsuits, court cases, Wells notices, and all the rest. But there haven't really been too many trials that have come to fruition as of yet. And so right now, sort of the best way that I'm advising folks to analyze this is to always do your homework on the token in question, on the operator in question, and to always work with an individual, be it a lawyer, CPA, or other asset management individual out there who has expertise in higher risk assets like gold, commodities, crypto, and also has the in-house expertise on the token in actual question.
And a lot of people wonder when it comes to contagion. Obviously, sometimes when you get some bad news about a token or about a platform, we do see that reverberate. But how much of this is contained within an FTX, within a Binance, versus sort of the industry-wide for crypto?
Mm-hmm. And so the ongoing cases against FTX, Coinbase, and Binance really are three different cases. FTX, more and more, based on the evidence and the allegations, isn't really so much a problem with crypto, but it really was a problem with how the company itself was actively managed. Coinbase is a really interesting case, right? As a platform here in the US, publicly traded, a audited enterprise, is also being sued by the SEC. So all of that's going to be interesting to see how they try to parse all of that out. And then ultimately, Binance has been on the hot seat pretty much ever since it opened up, right? Both here in the US, overseas, and there have been questions about who it's doing business with, how it's communicating to investors here in the US, and how it's handling funds from its external customers. So while all three cases are in the broader blockchain space, crypto space, all three of them really are different, and it's going to be really interesting to see how they all play out based on those individual facts.
So then outside of individual tokens, where are we seeing inflows when it comes to crypto or blockchain related stocks and investments?
Sure. So it's been very, very interesting that even as the SEC, CFTC, G7, OCC, pretty much every agency in the world has been trying to crack down and to enforce more compliance on the blockchain native operators, crypto native operators. It has been incredibly telling that pretty much every large financial institution in the world, be they asset management firms, banking institutions, or even college endowments, have been actively either trying to roll out their own products and services, be it ETFs, or they're actively implementing their own enterprise blockchains. So it's been really, really interesting to watch that as the blockchain space, crypto native companies are under extreme pressure right now, that other companies, TradFi companies, banks, all the rest are actively moving into those areas.
Always interesting to see what institutional investors are doing while sort of retail investors get caught up in some of the panic there. Great having you on. Sean Stein-Smith, business and economics professor at Lehman College. Thank you for joining me this morning. All right, coming up, Microsoft is announcing a new AI cybersecurity platform. We'll have those details for you after the break. Out this morning, Microsoft is announcing a new AI cybersecurity platform. Joining me with the latest is our very own Dan Howley. Hey, Dan.
That's right, Michelle. Microsoft today announced their security copilot platform. This is something that they're using ChatGPT technology, specifically OpenAI's GPT-4, to basically power an AI security bot. Now, what this means is companies that use cybersecurity protocols, which should really be every company, they'll be able to use this as kind of a almost extension of cybersecurity personnel. So they'll get a prompt box similar to what you would get if you used Bing right now or OpenAI's ChatGPT. Type in what you want about a incident that may have occurred, a hack, and you'll get a return from that prompt giving you information on a hack or intrusion. So one example they say is that an employee at a company, their device was compromised by a hacker. And so you type in information about that into this prompt box, and it runs you through the entire process of the hack, basically reverse engineering it. Now, for the average consumer, this means absolutely nothing. But for companies, and more importantly, Microsoft, it means easier access to more cybersecurity capabilities. For actual cybersecurity professionals, it should improve time for detecting incidents and remediating them. And so this is just kind of another example of Microsoft moving the OpenAI partnership that they have into more and more products. They already have Copilot for Microsoft 365. That's their productivity suite. And then obviously I mentioned Bing, as well as their new Edge browser with Bing built in. So they really are going whole hog into OpenAI and ChatGPT, as well as the whole generative AI landscape.
And Dan, staying in tech, Apple today introduced Apple Pay Later in the US, allowing users to split purchases across 4 payments, something we already see existing. Interesting move here for Apple.
Yeah, that's right. As you said, 4 payments. They're spread across 6 different weeks. One example is a $125 so payment that's split across $31.27, 3-week period. They show you a breakdown of it in a receipt. It'll be available similar to Apple Pay. This is going through MasterCard, so anyone that accepts Apple Pay should also be able to accept this. And it just shows Apple is diving further into the financing space. They already have their Apple Card. They offer financing through that with Goldman Sachs. And so you can expect them to kind of push further into this as they try to make their services segment more robust. The conversation always been about how they want services to be an important part of the company. It already is their second largest earner outside of the iPhone. They want to try to push that even further so they're not as reliant on the iPhone for that revenue.
All right, appreciate that update. Dan Howley there joining us this morning. All right, before we go, let's do a final check of the markets heading into the noon hour. A mixed picture, but we are seeing that selling action slowing down now. The Dow there still mixed, though, as we're seeing that the Dow up slightly, about 0.25%. The S&P and the Nasdaq still down, but only slightly. The Dow down about 3 points. The S&P down about 3 points. The Nasdaq down about 66 points, but far off the session lows of the day. Well, that'll do it for now. I'm Rochelle Akufo, and I'll be back with you at 11 a.m. Eastern. I'll see you then.